If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal: 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management, and that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No, equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get
for the whole year. Sasa, not for the whole year, for each of the months here, for each of the months. Now, what we need to do, we will have our months here in columns. So, for example, we'll have June, July, August, September, October, all the way to December. Then we will start with the revenue here. We start with the revenue of the company. After the revenue, we will less the cost of sales. We have what? The gross profit. And then we will less the operating what? Expenses like that, such that we will have now, for example, the gross profit for the 6 months, the operating profit for 6 months, and so on. So let's have now our months here. And basically, you can see we have various months. Let me first of all, copy this. We said whatever you can be able to copy, avoid a lot of typing. We paste it here. And then I'll have my months here. I'll have all these months. I will have all these months here. I think someone is not muted. Let me mute. Yes. So we will have all these months here. I will copy all these. And I hope you can see that these particular months here, they are in laws. These are basically laws. But I need those particular months now to appear to record. I need to record this month in columns. I'll start with July, August, like that. Now, how do I interchange data which is appearing in laws to be in columns? So basically what you do after copying, you come here and you paste. To paste, if for example you do direct pasting, you can see what is happening. But do we need that data to appear like that? Or those months to be like that? No, we want our months now to appear in columns. July, August, and so on. So I'll start my first month. I want my first month to start from here. So what I'll do, I will highlight that cell and then I will right click. Sasa, once I right click, okay, I need to, let me paste again, first of all. Let me paste this copy again, sorry. I copy this. So the first month should be here, then I right click. Once I right click, what is basically happening here? What is happening here? Yes, I hope you can see what we have here. I hope you can see what we have. Now, basically to interchange data which is in rows to be in column, we use this icon here. We come to the paste option, and we use this one. You see, this one is basically of transpose. To transpose is basically to interchange data which is in rows to be in columns, or data which is in column to be in rows. Sasa, I hope you can see once we use this option of pasting, I hope you can see what is happening. Now we have our month in what? We have our month in columns, and that is basically what we want. What we want. So having this now, then before I can proceed and record anything, I hope you can see that all the values which are given here in million of shillings. So I also need to come here and I note my figures will be in million of shillings. I'll basically copy this and then I paste that in all our months here. I don't have to copy to paste for each month individually. I will basically highlight all here this, and then I say what? Paste, Control V like that. So, and basically we can now make these columns to be, we can enlarge our columns. To enlarge our column, we must bring our cursors here. And then I hope you can see what is happening to our cursor. It is changing. And then you click, or yes, between the columns, you press hold, you drag like that. Press hold, drag. Press hold, drag like that. Press hold, drag again. Press hold, and then we do what? Drag again. Sasa, yes. Now we have that. Having this, we can equally bold this one. Bold, Control B. We say to bold, we say Control B. We Control B basically to bold. We control what? We Control B. Yes. Now I want us to start with the revenue. We start with the revenue of the company. So basically I'll pick this revenue. I copy. I paste it here. Control V. And then I also need to bring these figures here, all these values here. I'll copy all of them. Control C. And then the first value should start from here. But because these particular values equal, you can see they are in rows, we want them to appear in column. So we will use the same paste option, this one. That one, and I hope you can see now the values appear in what? Appears in a column. So to this, then we will proceed and basically we less the cost of sales. We copy this, we record it below our revenue, we paste here. Yes, and then I also need to copy all these values here. We say Control C, then we paste them here. Equally, we are going to use the same paste option, this one. And then below that, we will have what? The gross profit. Let me copy this. We paste it here. Yes. And I hope you can see what is happening with our wordings here. We need all of them to start from this cell. So you can do what? You can align left like that. Align left. Yes. I'll then need to copy this. Control C, and then I paste it here. Paste it here. Control what? Control V. Okay. Sorry. I need to use our paste option. Control C. Then I right click. I'll basically use this paste option. Paste what? Paste option. Yes, and I equally can underline all this because for us, we know to get the gross profit, we take the revenue minus the cost of sales. I can underline all that. So I'll say Control U. Control U is basically to underline. Control U is to underline like that. Now, having the gross profit, then we will basically move and we less the operating expenses. We copy this. We paste it here. Control V. So we align left, and then we copy all these particular expenses. Control C. Control. Okay, we right click and then we use this option. We use that option there. That option there. And I hope you can see basically what is happening to our figures here. Our figures, they are centering themselves. So to avoid a situation whereby some of the figures are either aligned left, others are, for example, centered, others are basically aligned right. So basically what you do, you can come up here and you introduce what? You introduce a comma here. You introduce a comma. So once you introduce a comma, so your figures will actually be aligned right. Let's introduce this. You can see what is happening now. All the figures are aligned on the right. And actually now you can do away with these decimals. We say to remove decimals, you use this. You use this. Do away with the 2 decimal places. You can see all our figures now. They are aligned what? They are aligned right. So then from there, we also aligned this. Control U, and basically we will be able to get these profit here. Earnings before interest, tax, and tax, depreciation, and amortization. I will basically copy this, and then I paste it here. I paste it here. So, and then I will be able to copy all this. Copy this. I say Control C. I basically paste it here, and I will use this function here to transpose. Then I will less depreciation and amortization. I copy this. Depreciation and amortization. I paste it here. And we said that if, for example, your figure, your wordings appear like this, we said what you need to do, you say lap the text. You come up here, lap the text such that you can see what is basically happening. And then we have said, because it is moving maybe past your boundary, say align left, like that. Sasa? Yes. So we copy all those values here. Control C. We paste them here. Control V. Okay. Sorry. We needed to use our paste option. We copy this. We right click, and then we use this. Okay. So then from there we will basically be able to move, and we get and I hope you can see also our figures here are aligning left. Okay, so we will be able to get EBIT. We copy. So whatever you have here is EBIT. We paste. Control V. And maybe this one we can say wrap the texts. And then we move it up like that. Yes, so we copy all these values here. Control C. And then we use our paste option here. Okay. Then basically I'll arrange this. Control U. And then we have interest. Copy. Paste it here. And then I'll have all these values here. Control C. I paste them here by using these options here. And then finally, I will have this one, EBIT. Earnings before tax. Earnings before tax. I paste it here. And then finally, I'll have the values here. I'll copy and then basically use this paste option. And because these figures here, you can see all of them are basically aligning. They are centered. Let me introduce a comma, and then I do away with those decimal places. Then equally the same case with these values here. I basically need a line of all of them on the left. Okay, so I think then we can also be able to align this profit here. We say Control U like that. Yes. So basically, in our case, you can see now we have been able to organize our data very well here. And therefore, moving, even when answering the other part of the question, then we will basically have very easy time, because all this what we have here, we are going to use these particular values in answering the other part of the question. The other part of what? Of the question. Now, basically, here we have been able to answer the first part, because in the first part of the question, we are required to show the total profit or loss of this particular company for the last what? Or actually for the 6 months. For the 6 what? For the 6 months. So we have been able to show the profit of this company for for the month of for the period of 6 months. Yes. Now, having that, I want us to move to Roman 2. Yes, I don't know whether there is any question up to that point. I hope you're together up to that point. Is there any question up to that particular point? Any question up to that point, or we can move to Roman 2? Is there any question? Any question? Okay, I think there is none. No question. Yes, no question. We proceed to Roman 2. So in Roman 2, basically, I think what we are required to do is still in our dashboard, we show the various profit margins. We show the various profit margin. In other terms, we are required to compute the various profit margin. And actually, we said anytime you hear the word of margin, this is also, from FR, anytime you hear the word margin, basically these are ratios which are computed, are profitability ratios which are computed using the revenue as the denominator. Using the revenue as the denominator. For example, gross profit margin. We take gross profit all over sales. Maybe we can also compute this margin. We compute earnings before interest, tax, depreciation, and amortization margin. So we will take this profit, divided that with the revenue. We can also compute this one, EBIT margin. We take this one divided by revenue. So anytime you hear the word margin, that ratio is always computed by having the revenue of the company as the denominator. And therefore, I will start by computing the gross profit margin. I'll start by computing the gross profit margin. So what I'll do, I'll basically, okay, let me show you how we make our work easier here. So I want to highlight these three because I want to copy this. Then I'll control. I'll also highlight that. I'll control, still holding the control button. Also, I copy that, okay? And also this one. I want us to copy those 4 values of profit. And then after highlighting all of them, I've said we highlight the first one, we control, we highlight the second one, still holding the control button, we copy we highlight the third one and the fourth one, and then we say control C. Control C, we will be able to copy all of them instead of copying each separately. So, and then we paste them down here. Control V like that. Control V like that. So you can see all of them have been copied and pasted down here. Now, I want us to make some changes because this one, I want us to compute the gross profit margin. I hope you can remember what we said. In case you want to make some changes, don't make it within your Excel worksheet. So just highlight, for example, this one is what we want to edit because we want it to be earnings before interest, tax, depreciation, amortization margin. So once you highlight this, it will automatically appear up here. You do your editing up there. So that will be, or basically we add the word margin at the end there, and then you can see what is happening. We say lab, just say lab. Then this one, EBIT, we want to add the word margin. We want to add the word what? Margin like that. Yes, the same case, this one, we want to add the word what? Margin. So therefore, never make those particular changes within your Excel what? Your Excel what? Worksheet. So any change you want to make, do it from up there. Do it from up there. Yes. So basically that's what we have. I want us to compute all this. And I'll say that we don't need even to cram the formula here. So we are going to compute all these particular profit margins by taking the respective profit, for example, the gross profit, divided that with the revenue. So therefore, how do we compute the gross profit margin for June 2023? I just need to develop a formula here And once I've developed that formula, I'll just compute this one for 2023, July 2023. And then using the formula which I will have developed here, I'll basically be able to apply that formula. And by default, Excel will be able to compute for me the ratios from August all the way to November. Because we said the main objective of Microsoft Excel is basically to make your work quite easy and also quite fast. So we compute this by taking what? We start always with the equal sign. We compute this by taking this gross profit divided by the revenue, this one. That is how we compute the gross profit what? Margin. We enter. We are getting 30.02. So this figure automatically is not in percentage. So this must be a percentage because it's a profitability ratio. So I'll introduce the percentage here up there. And also I can put this value to be in 2 decimal places. I just need to increase the decimal in 2 decimal places like that. Then I'll do the same for the other ratio here. I'll take this particular profit and then I divide that with the revenue here. The revenue there. What have I done here? Let me repeat. So this one divided by the revenue here. Yes. So basically we have that. So that figure, is it in percentage? No. We introduce this one, and equally we make it to be in 2 decimal places. 2 decimal places, we increase this to 2 decimal places like that. Yes. Then for the other one, we take whatever you have here, this one, divided by the revenue, like that. We enter, and then equally we can make it in to be in percentage. But basically, it's not a must you make each of the figure to be a percentage separately. You can make all of them. Like maybe let's compute the last margin, where we will take this divided by the revenue, we enter. So basically, instead of dealing with each, we can, for example, if this was still in in decimal places, we can highlight all of them. Like maybe let me reverse this. Okay, still is in percentage. Okay, so you can just highlight like these two, and then you come up here, you convert them to be percentage, and equally you do what? You make them to be in 2 decimal places. Now, once we have done that, basically take into account we have organized our data very well up here. So do we need to repeat that for August? Do we need to repeat that for July, October, November, and December? No. What we do, we have a formula here. I hope we said that if, for example, you want to see the formula for this, so you just highlight that cell. The formula for computing this will appear up here. And you can be able to see how we computed that value. We took this one should be in the denominator, in the numerator, because you can see the formula. Whatever is shaded in blue, the cell shaded in blue is the one which is the numerator. The value from the cell shaded in red is the one which is the denominator. Sasa, that is basically how we have computed that. So we have formulas for computing this. So that's why you can see when I'm computing these particular values, I'm not even typing anything. I'm basically picking these figures from whatever you have up here. So because that's what you need to do, you have developed a formula. Once you have developed a formula, so what you need to do, you highlight all these ratios. For July, remember you have for gross profit margin. So what you'll do, you'll basically apply that formula for the next 5 months. How do we apply our formula? So once you have highlighted this, bring your cursor here. I hope you can see where we have this like a dot, this one. Place your cursor there. Up to the time you can see our cursor is changing. I hope you can see once we bring our cursor there, it is doing what? It is changing. Then you do what? You press hold. You press hold your cursor, and then you do what? You drag. You drag. You drag up to the last what? Month. You drag up to the last month. Once you do that, then you release your cursor like that. Can you see what is happening? So basically by default, Excel has computed for us the ratios for the next what? 5 months. If you want to confirm how each of the value here has been computed, just highlight the respective value. like maybe you want to confirm how this has been computed, you highlight that cell. So what will happen? The formula for computing these will appear up here, and we can be able to confirm how that value has been computed. Automatically, we know this one has been computed by taking these values, 700. Is it 700? Yes, this 700 divided that with 41. Let's confirm. So automatically, once we do what? We highlight this particular formula here, you'll be able to see that the values used in computing this ratio will be highlighted. Let's see what happened. You can see now the values which are used. 700 divided that with what? Divided that with 41. Sasa, yes. So that basically how we do that. How we do that. I don't know whether that is clear. So this is saying that we didn't change the non-changing values. So this here, let's go back let's go back to our original formulas. Let's go back to our original formulas here. For example, in computing this, can you see what we have used? This. What have you used? We have used this value and this. Now, once we are computing the gross profit margin for August 2023, automatically we're going to use this and this. When computing this for September, we will use this and this. Now, the question is there a value which is not changing here? Is there a value which is not changing from what you have done? Is there a value which is not changing? Aboy, Moha, is there any value which is not changing here? Any value which is not changing? Actually, all values here are changing. All values are what? All values are changing. Sasa, yes, all values. There is nothing here which is not changing. That's why you can see we are not using the concept of locking here. There is nothing we need to lock. There is nothing we need to do what? There is nothing we need to lock. All of them are basically changing. So basically, what you need to do, first of all, is ensure that the formulas you are coming up with here and the formulas you want to apply, those formulas are the formulas are basically what are correct. So I think we are done with the Roman 2 of the question, and what you have computed are various profit margins. Remember, these are ratios. Let's move to the other part of the question. And basically, we are required to compute something called the days of purchases. Let me copy this. And basically, I'll have it here. I paste it. I'll paste this. Yes. So basically, in this case, we are required to compute the days of purchases. The days of purchases using the end of year balances. And basically, in this case, what you're required to do is to ignore the averages, to ignore the averages. Now, this basically is an efficiency ratio. So days of purchases, who can tell us the other name for this? Days of purchases. Days of purchases. Days of purchases. DOP, days of purchases. Now, the days of purchases, this, in other terms, we refer to this as the trade payables payment period. This is something basically we came across yesterday. In other terms, we refer to this as the trade payables payment period. Trade payables payment period. Now, in this case, when we talk about the trade payables payment period, basically this refers to the number of days a business is taking, or basically a company is taking, to pay the suppliers. How many days on average was the company taking to pay the suppliers? And actually, this one we computed by taking the average trade payables, divided that with the credit purchases. But remember, you said, in case you're not given the credit purchases, I think there is someone who asked that question yesterday, we use the cost of sales instead. So therefore, to compute this, we take the average trade payables, but there is also something we are told here to ignore the average. We will not use the average. So therefore, instead of average trade payables, we will just use the trade payables at the end. We will use the trade payables at the end of each month. And basically, we divide that with what? We divide that with the credit purchases, or actually purchases for that case, credit purchases. And then we multiply this with what? We multiply that with the number of days in a year. We multiply this with the number of days in a year. So in this case, there is somewhere we are told here, assume, I hope you can see this, assume 360 days in a year, and that inventory at the beginning of July was 900 million. Yes. So basically, in this case, we will multiply this with 360 days. 360 days like that. 360 days. Yes, 360 days. So basically that what you just needed to know, that days of purchases is the same with the trade payables payment period. And basically we compute this by taking the trade payables, divided that with the credit purchases. Now, from the information which we have in our question here, we already have payables here. Payables, that one is given. But now do we have credit purchases? Do we have the credit purchases, or do we have, in other terms, purchases? No, we don't have purchases from our question here. But in our case, we can be able to compute purchases. Take into account there is something we are given here. We have this inventory. Remember, this is end of month inventory. This is the closing inventory. We have the closing inventory, and then there is somewhere here, in this point, we are given the opening inventory in July. So if, for example, you have the cost of sales, you have opening inventory, you have the closing inventory, you can compute purchases. Because we know to compute purchases, to compute the cost of sales, we take opening inventory plus purchases minus what? Minus closing inventory. Let me put it here. So basically, we know that to compute the cost of our sales, and I need you to be very, very keen here. So we take the opening inventory, we add what? We add purchases, we minus the closing inventory. That's basically what we know. Now, in our question here, what is missing is purchases. So we make purchases the subject of the formula. So we will bring all these to the other side. So this one will be equal to cost of sales. We bring all these to the other side, will be equal to cost of sales. Once we bring the opening inventories to the other side, it will be minus opening inventory, and then plus closing inventory. Plus closing inventory. So what we have just done is basically to make purchases the subject of the formula. So this is basically the formula which is required to help us in terms of computing what? To help us in terms of computing the in terms of computing purchases. In terms of computing purchases. And actually, we are going to compute the purchases for each month here. For each month. So therefore, what I need to do here, I'll basically copy all these months here. And remember, all our figures also are in million of shillings. I'll copy all these. And make sure that whenever you work with, or basically whenever you're computing anything down here, your data, whatever, in terms of how you are arranging your months should be in the same column, because that helps you whenever you're using a certain formula. For example, make sure your first months are starting from that column here. So we paste like that. We paste, yes. Now remember, we want to compute purchases. So what I will start with, I will start with the cost of sales, because do we have the cost of sales? Yes, we have the cost of sales in our case. We have the cost of sales. Cost of sales. In fact, we may decide not to repeat the cost of sales. We may decide not to repeat the cost of sales here because we already have the cost of sales down up here. We can be able to work with it still whenever it is here. So I think let's do this. Let's we start with the closing inventory here. Closing inventory, because this one we already have it. Closing inventory. Closing inventory, no problem with this. This one we have it. This is basically what we have here. This is end of month. End of month meaning that this is the closing inventory. I'll copy all this and then I paste it here. We must use this option of transposing. That is basically the closing inventory. And then we also have the opening inventory. Opening inventory. I need you to be very, very keen here, because this was, I think, the only tricky part as far as this question is concerned. So the opening inventory, basically, we are told here in our question, we are told assume a 365 days in a year, and the inventory at the beginning of July was 900 million. So basically, we are given inventory here to be 900 million. To be 900 million. Now, who can tell us what will be the opening inventory in August? This is something now you need to know. What will be the opening inventory in August from what we have here? So remember what you're doing. I think this concept was in May. Management accounting. Management accounting. Yes, that is very correct. That the opening inventory in August will be the closing inventory in July. So this opening inventory here is the closing inventory in July. And I will not type. Basically, I want to just to develop a formula. So the opening inventory here will be this one, like that. So basically, once you do that, this is like a formula we have developed. So if you apply that formula, by default, Excel will be able to pick for you what? Will be able to pick for you, will be able to pick for you the opening inventory for each month. Let's release our cursor and you can see what is happening. So the closing inventory here is the opening inventory. The closing inventory here is the opening inventory in the following month. Closing inventory here, opening inventory here. Closing inventory here, opening inventory here. Sasa? Yes. So having that, then I think we can proceed and we compute now what? We compute purchases. We compute purchases. So purchases, we are applying this formula here. So our purchases, this one, I need to come up with a formula. We are using this formula is equal to the cost of sales. The cost of sales, we have it here. This one, cost of sales. Don't type, pick that value because we are coming up with a formula. We basically minus the opening inventory, which is this one. We add the closing inventory. We add the closing inventory, and I hope that our formula here is okay, because you have said we bring this to the other side, it will be a negative. This to the other side, it will be a positive. Yes, that is correct. So therefore, to compute purchases, we are taking cost of sales. Cost of sales, this one, 24, minus the opening inventory, this one, plus closing inventory, that one. Sasa, that is a formula. That is basically a formula. Then what I need to do is to enter. Once I have that, I don't need to repeat the same computation for the other month. We already have a formula. What we will do, we will apply our formula like that. By default, Excel compute for us those values. And we can confirm any value. For example, we can confirm how this value has been computed. Just highlight that cell, the formula for computing that appear up there. We can just confirm. Is that how the purchase is supposed to be computed as per our formula? It should be a cost of sales. Cost of sales, you can see the first value come from the cell S8, which is shaded in blue. And it's this one. This is the cell S8. S8. Yes. Plus, or basically minus the figure which is from the cell which is in lead, which is basically this one, and that is the opening inventory, plus the other value, which is the from the cell which is shaded in what? In purple. And that is the crossing what? The crossing inventory. So I think in our case, basically now we are done with that. So having that now, we can be able to proceed and we compute this. We can be able to proceed and compute the days of purchases, which is also called the trade payables payment period. I'll just copy that and then I paste it here. And I equally what I'll do, I'll have to bold this one, control B to bold. So I'll basically apply my formula here. To compute the days of purchases or the trade payables payment period, I'll basically apply this formula. I'll take the trade payables. Do we have the trade payables here? No. I think the first thing we need to do, let's bring the trade payables here. Let's bring the trade payables. I'll cut this. To cut, we needed to move it to the column down, to this column here, not column, rather this row. I'll cut. To cut is we said we control X, cut, and then paste. What I need to have here is the trade payables. The trade payables. The trade payables, we have those values here. I'll copy this and then I'll basically paste it here. Remember, we are going to use this paste option. Yes. And I think having that now, we have everything which is required. So we just need to compute this. So we will apply our formula, this one, trade payables, which we have here, divided by purchases, credit purchases. Now, in this case, if for example, you're given a question, the question is silent on how much were credit purchases, you assume all purchases were on credit. The question is silent. We assume all purchases were on credit, this one. And then I multiply that with 360. I multiply that with what? With basically 360. So 360, this one, I can type it. So, but if, for example, I'm picking this figure now from a cell here, assuming 360 is on a cell, so automatically I would have used now the concept of blocking, because that 360 will not do what? Will not change. But once you type it, automatically the figure will not change. But if you're picking it from a cell here, you must do what? You must block that. So I enter that. Basically will give us 105, and these are basically days. And then what I'll do here, I'll basically apply that formula. I'll apply that formula across. And even before we apply that, you can see how that value has been computed. Payables divided by purchases times 360. So I'll basically apply that formula. And I hope you can see that has changed now to 2 decimal places. I'll apply that formula like that. So basically, these are the number of days on average our company was taking to do what? To pay the suppliers. To pay the suppliers. So that is it. That basically what was required there. That was I think the only tricky part, because the purchases had to be computed. So then let's move to the other ratio, which is basically ratio number 4. Let's move to ratio number 4. I'll paste that, and basically I'll copy that, I paste it here. I paste it here. Yes, I can also make this, I can bold this. Control B, I can also shade it to be more clear on what I'm computing here. Yes. Now, in this case, the first thing we need to ask ourselves is, what is days of inventory? Days of inventory is also a ratio we came across. I don't know whether you can be able to tell me what is this, days of inventory. Days of inventory, any idea? Okay, yes. So someone is asking, should the days be in decimals? Actually, this should not be in decimals. I think that is a good question. So you may decide therefore to put these values to whole numbers. So basically what you need to do is to do away those decimals. To do away the decimals, you come up here, and then you do what? You reduce. You reduce. That is to increase this, to reduce, to decrease the decimals. Put your values to the nearest whole number, like that. That's yes. So days of inventory, who can tell us what do you mean by this? Days of inventory? Days of inventory. Days of inventory, basically, in other terms, is what we refer as the inventory turnover. Inventory turnover in days. This is basically a ratio which is computed to determine, on average, the number of days the company was taking to sell the inventory, to sell the goods. Yes, so this one is also called the inventory turnover in days. Turnover in what? Turnover in days. Turnover in days. So how do we compute this one? So basically this one is computed by taking the costs, the cost of sales. We take what? We take the cost of sales. Sorry, not the cost of sales, rather. Sorry, it should be the average inventory. Because yes, we take the average inventory over cost of sales times 360. But in this case, we are told to assume the in average. So basically what we will do here, we will take the inventory, specifically the closing inventory. The closing inventory, let me put it here as a closing inventory. Closing inventory. We divide that now with what is called the cost of sales. Cost of sales. And basically we multiply that with the number of days in a year. That is 360 days, 360 days. Yes. So this one is quite simple, because I think we have almost everything. We have we have the closing inventory. We have the cost of sales. So this one is just a matter of computing it. And I think let me pick the month. Control C, Control V. We said all our months will be starting from this column. Yes. So this one we compute the days of inventory. The days of inventory. So we are just applying our formula here. I'll start with July. I'll take the closing inventory, which we have here. Don't type, just pick the value, divided by the cost of sales. Cost of sales, we have it up here. Pick whatever you have here. So this is the beauty with Excel. You can be able to link so many cells. So multiply that with 36. Then we do what? We enter. So then what we do, we basically apply that formula like that. So we make sure our values are to the nearest whole number. Our values are to the nearest whole what? Number, to the nearest whole number. So that is basically what we refer as what? The days of inventory. The days of what? Of inventory. I want us to do the last ratio before we take a short break. This one. Yes, the days of sales. So the days of sales, who can tell us which will be the other name for this? Days of sales. 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 Days of sales basically is once you make sales, how many days on average are your customers taking to pay? Tasa? Yes, how many days on average are your customers taking to pay? Therefore, in other terms, this one we refer to it as the trade. We refer to this as the trade receivables correction period. Correction period. How do we compute this one? We compute this one by taking the receivables, that is the trade receivables, receivables. We basically divide that with the credit sales. Sales, remember, is another name for what? Is another name for revenue. And basically we multiply that with 360 days, 360 days. Yes, like that. So I think in our case, we already have the sales. So what is missing here is the receivable. So what I'll do from the data which were given here, I'll basically bring these values for receivables here. I'll basically copy this. Okay, I think let's first of all, we copy the month. We copy this, we copy the month.
Could you remember? If you cannot remember, basically you can start at this point when those who are there, those who can remember will come, will continue from there. So we just proceed. Okay, thank you. So let's look at this question. On April 2023, the question asks, outline 5 ways in which management may deter unethical behavior in its employees. Unethical behavior are basically unwanted behaviors in the company. We call them unethical behavior. So if you're a manager of a company, how can you be able to deter or prevent these bad behaviors from occurring in your organization? So the first one is establish a code of ethics. So as a company, you should develop a code of ethics. That's how people should be able to operate. Develop a code of ethics. And then after you've taken your employees through it, ensure that they sign. So that what? They know the expected level of behavior or their expectable behavior or how they are expected to behave. So ensure that you create that. So the parliament can develop and disseminate formal code of ethics that outlines acceptable behaviors and decision-making standards. So basically, when you have the code of conduct or code of ethics, each and every employee will be taken through it. They understand, and then they'll be expected to ensure that what they behave in line with what the code of ethics. Number two is what? Leading by example. This is very true. You cannot expect people to behave ethically as a manager and they see you to be very unethical. So what you do, if you can only demand what you have. So basically, if you want people to behave ethically, then also ensure that what? You also behave ethically. So that's what happens. So if you want your employees to behave in an ethical manner, then lead by example. That's what you need to do. Lead by example. If you don't lead by example, then employees will just see you are like what? You are just a busybody. So employees, for them to be able to follow the right or to behave ethically, you must show them. So you can only preach what you do. Then we go to number 3. Another way in which a manager can prevent unethical behavior is what? Implementing ethics training program. So basically, ensure that in training of your employees, ensure that what? Ethics training is also part of it. They train people to be ethical, train people to behave professionally and behave in what? In the right manner. So provide regular training on ethical issues, ensure that employees understand how to handle ethical dilemma and reinforce. So basically, if you train employees on ethics, basically understand the effects of unethical behavior, be able to know how unethical behavior can impact the company negatively. Number 4 is what? Creating whistleblower mechanism. This is very true. So ensure that what you give a chance to some employees. If an employee has got some, or an employee has got some information on some unethical behaviors in the company, they can be able to what whistleblow, maybe anonymously. They can maybe write something on a suggestion box, or they can just what? They can just find a way of reporting it. So once they report, a whistleblower is not normally, you don't unearth a whistleblower. If I come and whistleblow for you, you don't say that I'm the one who said it. Basically, whistleblowers are normally, you need to consider them what? Anonymous. So if there's a whistleblower in the whistleblowing mechanism in a company, then people don't know. So they look at you, if they look at me and they think, somebody may think I'm a whistleblower. That's what happens. So with whistleblowing, somebody may look at Dorcas. This Dorcas is my staff member, but I don't know if it's a whistleblower. Remolinga also say that, hey, this Dorcas. So basically, everybody will be curious with one another, and that will make sure that what people do the right thing. And then the last one is what? Enforcing discipline. Enforcing disciplinary measures consistently. So if somebody behaves unethically, which action are taken against them? So basically, so Malaria should apply sanctions and disciplinary measures consistently against unethical behavior, regardless of the position or seniority. Means what? If somebody behaves unethically, whether it's the CEO of the company, the disciplinary action taken against him should be consistent. So if a junior employee acted unethically and was suspended for 2 months, if the CEO or the senior management also act unethically, they should also be what? Suspended for 2 months. Means what? You must ensure that what you have consistent. But if other people you are punishing more, others you are not just punishing, then basically becomes so ensure that what? There's consistency. The next question here is asking, question 1B is asking, let me highlight in a different color, say that, discuss 5 biases which affect decision making in our nation. So we talk about biases. That bias is basically something that drives you towards making given decision. We call them biases. So we call them biases, basically. So for example, my experience in life can be biased. Means when I'm making decisions, I make decisions based on what? On my experience in life. So experience can be biased. So I make decisions that what? Maybe I'm going to anchor my belief. So number one is called what? Confirmation bias. We talked about these biases when we talk about decision making. The first one is called confirmation bias. Now, when we talk about confirmation bias, what do you mean? So this occurs when decision makers seek out information that support their existing beliefs. So in this case, I just want information that support my beliefs. So anything that goes against my beliefs. So my decisions are going to be made based on what? On the information that is able to support my beliefs. That's what I believe that decision. Then number 2, we have what's called anchoring bias. Another second type of bias is called anchoring bias. So anchoring happens when individuals rely too heavily on the first piece of information they receive, called the anchor, and fail to adjust their judgment adequately as new information becomes available. So there are people that they use the initial information they had. So even if you bring a new idea, they don't look at it as new. So basically, they do like that. They do that. Basically, their first experience will determine how they make decisions all their life. So basically, that means what? It's about the anchor, the first experience. That's what we do. Then number 3 is called overconfidence bias. There's people that are also very confident. You bring an issue to them, say, well, this one, I've made this decision several times, so it's not the first time. Let me just, so that overconfidence can also be a problem, because what? Being overconfident means what? You may not really want to get opinion of other people. So decision makers may overestimate their knowledge, abilities, or accuracy of their focus. So overconfidence can make you overestimate. You may think that you know more. You are all knowing all. You have all the ability, but in this sense, you may not have that. So often results in taking excessive risks and ignoring potential pitfalls. So if you have overconfidence of something, you may end up messing up. That's what you're saying in that point. Then you have what's called availability bias. Another one. It's called availability heuristic bias or availability heuristic. So this bias occurs when people base decisions on information that is most readily available or recent. So in this case, I make my judgment based on the most recent occurrence or what the information that's really available. I don't want to do more research. I want just to what? Base my decisions on what? On the most recent information or the most recent information. Then you have the groupthink, and this one I've talked about it severally. Groupthink is a case whereby you want to ensure that there's harmony in the group. You may have a contrary opinion, but you say that for the sake of the harmony of the group, I don't want to what? I don't want to bring a controversial point. So those ones happen in a case whereby what? Somebody feel like what? If I come up with my opinion, people may look at me like what? I'm trying to sabotage the decision making. So basically, let me just agree with whatever each and every other person is saying. So that is what we call what? That is what we call groupthink. So those are some of the biases that affect decision making in the organization. Then question 3 is asking, with reference to management, explain the term power. Yes. So this question is asking us to define power in relations to what? Management, or the reference. Because definition of power can be defined in different ways depending on the industry. For example, there's power in physics. Those who have done physics, there's a topic called power. But in this case, they want you to define power in relation to what? Leadership and management. So that if you define power based on physics or any other scientific topic or scientific subject, then basically you may end up losing. That's why we need to ensure that what we define. The instruction is you define it based on what? Based on management. So that power is in management first what? Ability of an individual or group to influence the behavior, decisions, or actions of others to achieve desired outcomes. So basically, power is, in simple terms, is ability to what? Influence. Ability to make people behave in a particular manner. That's called power. So power and authority are different things. Authority is power given to you based on the position you're holding in a company. For example, if you're a manager, you have some power. You can administer punishment and rewards as a manager. That's the power. And that power comes from a position. But there are some people without formal position but very powerful. So you need to understand what power. Power basically is what? Ability to influence other people's decisions. Now, then the second or the Roman 2 of that question is asking, distinguish between legitimate power and reward power. So I want to look at the difference between what? Legitimate power and reward power. What's the difference between these two types of power? So in looking at the differences, we want to look at them from the various aspects. So we want to come out with those differences from various aspects. That is what I want us to look at. Get those differences from the various aspects. Let me just try to color them so that you can see. I'm trying to color them so that you are able to see. This is the last one. Now, let's look at these distinctions or difference between these two types. So we have the aspect legitimate and then what? And then reward power. So in terms of definition, what's the definition of legitimate power? And what's the definition of what? Of reward power. So we want to look at it from that perspective. So definition, so legitimate power is power derived from an official position or role in the company. So basically, if I'm a manager or the HOD, then I have some power given to do based on what? Based on the position I'm holding. So that's called what? That's called legitimate power. Means what? It's based on the role I'm given in the company. What about reward power? So this power derived from the ability to offer rewards or incentives. So basically, if, for example, you are the one that gives recommendation for promotions. So if you're the manager who is able to push in some good word in terms of recommendations for me to get promoted, then you possess what's called reward power. Then in terms of the source, where does legitimate power come from, and where does reward power come from? Want to look at them, that difference in terms of what? In terms of source. So legitimate power is based on organization hierarchy and formal authority, the position you're holding in the hierarchy. Are you top level management, mid, lower level? That's where legitimate power come from. What about reward power? Based on control of valued outcomes like bonuses, promotions, or perks. So if you're the one that is giving these bonuses in the company, you're the one that is giving giving bonuses, you're the one who is giving promotions, you're the one that is promoting people, you're the one that is giving some perks. So the mere fact that for me to get perks in the company or in the organization, I have to go through you. Basically, you have what we call what? Reward power. That is very, very important to understand. Then example, we want to look at examples of reward power and talk about reward power. What is a good example of reward power? Now, say that a manager assigning tasks. So example of reward power is what? A manager assigning tasks to subordinates. So I can decide, for example, if I'm the one assigning task, I can decide to assign somebody a weaker task, while somebody I give a very challenging task. So if you're my friend, I put you in a task that I think is not going to expose you. If you're not my friends, I put you in the most difficult task in the company. So basically, that's what. So I can come and start lobbying with you. So basically, those ones are called what? Reward power. If people are going to the field, you say, out of Nairobi, I want to be within. So basically, those are aspects when you talk about what? Issues of reward power, how they come. If, for example, you are the one that is giving, allocating people, and you see the far somebody goes, the more they get maybe per diems. So you can decide that only your friends go to areas where what? There's more per diem. That's reward power, the example. Then limitations. What are the disadvantages of this reward power? Limitations. And one is what? Maybe ineffective without respect or credibility. Sometimes when you only possess reward power, you may still become very ineffective, because if the rewards are taken away from you, what happens? So that's why sometimes this reward power. So that means what? The day when you don't have the rewards, what happens to you? You become powerless. So that's one. Then what about, that is the legitimate power. So maybe ineffective without respect or credibility. So you may be a manager, but don't have respect. People don't respect you. So that is one of the problems. Then what are some of the, in terms of reward power, what are the limitations of reward power? So may lose influence if rewards are limited or expected. So if I know that you are not the one, we have structure. So me getting promoted does not depend on you. Then basically, you don't become powerless, because if people depend on you to get to promote them, so that means what? If you don't have reward power, then basically your power disappears. So that's what. Then the next question here is asking, examine 5 pricing strategies that organizations could employ in a competitive market. So this is a topic on marketing. So this question is asking us to be able to what? To look at what we call value or types of what? Marketing. We call them marketing strategies that we have at our disposal as a company. So what are some of the marketing strategies that as a company we can use in a competitive market? Not just a market, but what? In a market which is what? Very competitive. Number one is what? What's called penetration pricing. Now, penetration pricing in simple term means you come or you price materials or items cheaper than competitors. So you price them slightly cheaper, so that what? You're able to attract. You want to penetrate the market. You're new, maybe you're a new company. You want to penetrate the market. So what do? You ensure that what? You come to the market with very cheap price. And with those cheap price, when you have those cheap price, then what happens is that you're able to what? Attract. Basically, African or the Kenyan customer is normally very price sensitive. So if you come with a good price, they'll basically come to you. So the strategy involves setting low initial price to quickly attract customers and gain market share. So this one, what? You come up with what? Very low power or a very low price than competitors. That is called penetration price. Then number 2 is called price skimming. You can also come up with the price skimming strategy. So high price is set initially to target customers willing to pay a premium. So in this case, you come to the market with what? Very high price. There are people that believe that what? The higher the price, the better the quality. Pay a premium price. Prices are then lowered over time to attract more price-sensitive customers. So you come, first thing you come with very high price, what we call the premium price, and then with time you lower price so that you're able to compete effectively in the market. That is what we refer to as what we refer to as price skimming. Then we have from price skimming, we have another one called competitive pricing. So this one is also very interesting. What you do here is you look at what other people are pricing. So if I come to the market and Remolinga is there, and also we are selling the same thing, Remolinga and Dorcas. So what I do is ask myself, how much is Dorcas selling? Dorcas selling it at 20. How about Remolinga selling them at 18? So let me also put mine at 19. So that means what? The price you set is determined by what? Is determined by the market forces, demand and supply. So you cannot come and start selling at 80. You look at what others are pricing. So that what? Prices are set based on what the competitors are charging. So you charge, how you charge depends on what competitors are charging. The nations may choose to match, undercut, or slightly exceed. So in competitive pricing, number one, you can sell at the same price. If you're selling at 20, sell at 20. Or you can decide to undercut. Undercut means what? They're selling at 20, sell at 19 or 18. Or exceed. They're selling at 20, you can sell at 22. So basically, those are some of the ways you can do it. Then you have what's called psychological pricing. This one is basically mindset. So prices are set to appear more attractive to consumers, e.g., 999 instead of what? 10,000. This strategy takes advantage of what? Customer perception rather than what? Real cost difference. So in this case, for example, somebody say that what? We are selling suits at 9,999. Somebody is saying that I'm selling suit at 10,000. So in the mind of consumer, psychologically, a consumer say that what? 999 is cheaper than 1,000. But if you look at it in terms of real cost, 99 and 100 shillings in terms of cost basically is very minimal. So, but because human beings were made we're made in such a manner, we normally we normally just try to ensure that we use our psychology, the plan of our psychology. Then we have another pricing strategy called the value-based pricing. So this will be you price items in relation to or you price item depending on your perception. So you price item depending on the perception you give. So if consumers have a perception of high value of your product, you charge highly. If you believe that the perception is low, then basically you charge. So that's what you call That's what you call value-based price. So pricing is determined by the perceived value of the product or service to the customer rather than the cost. So in this case, if you see that you believe that whatever you're offering is very valuable for customers, you charge them highly. If you believe that is not so valuable, then you charge them low price. That's called That's called value-based. So these are the pricing strategies that you'll have at your disposal in a competitive market. So talk about penetration pricing means you come with a low price. Then price skimming, you come with a high price, then lower the price. Competitive pricing, whereby you charge goods and services based on what customers, other suppliers are charging. Then psychological pricing, you talk about 99, 999, 999 instead of a full value. Then value pricing means you charge items based on the value you perceive customers are getting from product or service. Now, from that, we go to a next question here. Say, outline 5 ways in which a leader plays a role in change. A leader plays a role of a change agent in an organization. Talk about ways. Which ways will show that a leader is a change agent? How or which ways? Which are some of the ways in which a leader can play a change agent role. That's basically what we are struggling with here. Number one is communicating the vision clearly. So if you want us to believe you're a change agent, then let us know the goals of the company, the beliefs, and explain to us why this change is important. So you must let us know that we are changing, or we want to bring this change because of. So basically, that is what we'll able to what? We'll able to be a change agent. If you explain to us well, and we understand, and we say that's going to help us, then basically we buy into your idea. Number two is what? Challenging the status quo. Number two is challenging the status quo. What does that mean? Means you want things to be done differently. You want things to be done in a different manner. So you don't want people to just become comfortable where they are. You want people to also try as much as possible what? So the leader questions outdated system. You want to bring a new system, practices, or beliefs. So if you think that there's an outdated system, you interrogate it. If there's an outdated practice and belief, basically you try to ensure that what? You bring a new one, or to ensure that what? You're able to move on. Then number three is what? Empowering employees. A leader who wants to play a role in coming up with the change should be someone who is empowering employees. So by involving staff in the change process and providing resources and authority, the leader enables ownership and commitment. So basically, ensure that what? You engage staff. Let staff be part of the change. Let them give their opinion. Let them be in the committees. That's one. Then demonstrating commitment. So leaders who model desired behavior and actively participate in change initiatives inspire confidence and reinforce the importance of what? Transformation. So basically, you must demonstrate commitment to the change. Then number five is what? Managing resistance. So if you want to be a change agent, you must find a way in which what? You manage resistance. You try to reduce resistance to change. So the leader identifies source of resistance and address concerns through dialogue, training, and support, thereby easing. So basically, if you know that there's an area where there's resistance to that change, you can go there, explain to people, address the challenge, give them confidence, convince them. So that's basically will make you be considered a change agent. As a leader, you will be considered a change agent. Very, very important that you understand that concept. Next one is question 4B. Question 4B. Question 4B saying, explain 5 essentials of a sound motivational system that might aid in reducing high rate of staff turnover in an organization. Now, when you talk about staff turnover means the rate at which people are leaving the company. People are coming and leaving. That is what we call staff turnover rate. So if your company staff come today, tomorrow they're not there, then your staff turnover rate is high. That means there's a problem. Why are staff coming and leaving immediately? There's a problem in that company. So how can you be able to what? How can you come with a good system? So number one is what? Fair and competitive compensation. Means what? If you want to motivate people, let the system be fair. So that if Remolinga gets the reward or is getting motivated, I'm happy that, hey, Dorocas deserves it. If Remolinga gets something, we say that he deserves it from the work he has done. But a case where we start saying that Dorocas was given this reward because it's a relative to so-and-so, because a friend so-and-so, then basically we start losing ground. We must ensure that what? The reward system should ensure that what should be fair and competitive. Number two, recognition and reward. So a system that acknowledges achievements both formally and informally boost morale and encourage. There's something called recognition. If you're working in a company and then Ondieki does something good and then I just go to Ondieki and tell Ondieki, you have done a good job, then say, that's good, that's great. Then that will not motivate Ondieki so much. Then when I go to where all staff are in a meeting and say that Ondieki has done a good job for us, can you people clap for Ondieki? It makes more impact. So talk about what? Recognize and recognizing the reward. Number three is what? Opportunity for growth and advancement. So providing clear paths and training, training and promotion keeps the employees engaged and reduce the temptation to seek opportunity elsewhere. So if you have, if an employee sees that in this company, I can move up the ladder, that one makes employees want to stay in that company because they know that within a short time, they will start coming up until they reach what the peak of the company. And then good working conditions. So you can also be able to eliminate a staff turnover if you have what's called what? A good working condition. If your employees are having bad or poor working conditions and they get an offer somewhere, so they leave because they said what, hey, at least I'm going to a better. So ensure that what the working condition is okay. Then employee involvement and decision making. So employees also want to be part of decision making. So if you normally engage employees or involve employees in decision making, then they feel happy. But a case where they feel like their views are not heard, when they give a suggestion, you don't care. So basically, such kind of employees, some of them may just say, well, with this company, let me go somewhere where at least what? At least my opinion can also matter. So you'll find very high staff turnover rate in these companies. Now, from that question, we go to the next question. And the next question is asking, summarize 5 factors that might hinder creativity and innovation in a company. Which factor can make it difficult for employees of the company to be innovative and also be creative? So we talk about what? Factor that hinder means what? They frustrate or they try to block creativity and innovation. Number one is rigid, hierarchical, and bureaucracy. When there's a lot of hierarchy, for you to do something, you have to consult A, B, C, and D. You may end up what? Making innovation. Then bureaucracy, a lot of documentation, a lot of procedures. Those one what will make it difficult for what? For employees to become creative. Number two is what? Fear of failure. This is another factor that normally affects creativity. If you fear of failing, then you don't try anything. Life is a risk. So risk, doing a risk, you can come up with a new good, very good product. In risking, you can risk and what? End up losing everything. So basically, take it. So don't be somebody who is afraid to fail. Fail and then learn from it. Then lack of resources. So insufficient time, funds, or tools can hinder employment to what? Explore. So basically, if for me to be innovative, I need to have laptop, internet, some tools. If I don't have them, basically, I cannot be creative. Some people are not creative because of what? They lack resources. Then number 4 is what? Inadequate leadership support. If the leaders don't support the change or the innovation, you won't be, because they're the ones that are supposed to what? Give you resources. Things like money for research, things like, so basically, if management of a company doesn't support creativity, you will end up what? You'll end up not becoming creative. So if they are supporting creativity, means what? They allow people even to what? Make mistake and still value their efforts. Then poor communication, this is another one. If there's no better communication, then basically we are able to ensure that what? We are able to, creativity can be stifled. People need to be in open communication whereby they can express their ideas without a problem. So if there's poor communication, then basically they can be, so barriers to communication reduce collaboration, working together, knowledge sharing, and cross-functional innovation. So those are some of the some of the factors that may hinder or may reduce chances of what we call innovation in a company. Good. So we are at 12:54. We can do one question before we can do part of question 5 before we can go for a break, or we can finish question 5. Let's see how far we can go before we have a small break. Yes, we can finish this question 5, then have a small break. Now, the next question 5 says, explain 5 benefits of conflict in a company. Now, this one is a very controversial question. We know that conflict is not good. Ask people about conflict. What do you think? Somebody asks you, do you think conflict is good for the company? Or say it's not good. Now, but there are some positive aspects of conflicts. Number one is what? Stimulates innovation and creativity. When there's a conflict, you think on how to come up with what? A better way of what? So resolving the conflict. So basically, conflict. So conflict can lead to what? Diverse viewpoints and challenge conventional thinking. That's what? So basically, through conflict, you're able to what? Come up with new ideas. Then encourages open communication. So healthy conflict promotes dialogue, helping uncover hidden problems and clarifying what? And clarifying misunderstandings. So basically, we talk about aspect of what? Encourages. So when there's a conflict, you want to find solution. So in finding solution, you communicate with various stakeholders. Then improve problem solving. So that through conflict, organizations can identify root cause of issues and implement effective long-term solutions. So through conflict, we're able to what? Identify some of the problems, and then what? Make right decisions to solve them. Then enhance group cohesion if managed well. Sometimes, if you look at what's called a group formation process, we have the forming, storming, performing, and so basically, for a group to move on smoothly, first there must be the storming stage. Storming stage means what? There are conflicts, people are fighting for leadership and all those things. Then resolving conflicts can build trust. So if you resolve conflict very good in the or effectively in a company, basically, we build trust among the members. Then promotes personal and professional growth. So when there's a conflict, as an individual, you learn many things. One of them is what? You learn tolerance, how to tolerate situations. You learn negotiation, and you learn what? Communication skills. So basically, that one is one of the advantages of what? Of conflict in the company. So you see, conflict can be very positive also. The next question here asks, discuss 5 techniques of scientific management as proposed by Frederick Taylor. So these are basically Frederick Taylor's techniques of management. So Frederick Taylor came up with some of the techniques that can be used in management. So number one is what? Time and motion study. So Taylor emphasizes the scientific of tasks, thereby the most efficient way to perform them. So he said that what? Let's look at various functions scientifically and what? Come up with what? Better solutions to those problems. So observations and measurements can help what? Number 2 is what? Standardization work. So also Taylor talked about what? That's what? For us to be able to work well, the work must standardize. So he advocated for use of standardized tools, methods, and working conditions to improve efficiency and reduce. So he will say that what? Let us what? Standardize work by using standardized tools, methods, and also what? Working conditions. Then number 3 is what? Scientific selection and training workers. So he said that what? If you're going to select a worker to work for you, ensure that what? You select them scientifically. At the same time, talk about training. You ensure that what? Your workers are trained well, so that with the good training, we are able to what? They're able to ensure that what? We manage the company. We apply what? Scientific management. Next one is what? Differential piece rate system. There's something called differential piece rate system. What does this mean? So the incentive system pay workers based on their output, encouraging higher productivity by rewarding efficiency and what? Hard work. So in this case, what happens? What? You reward people for doing a job. So the more output you give us, the more we reward you. And then last one is what? Division of work between managers and workers. So is that what? For the company to run well, there must be division of work. Division of what? Of work. So that managers do their managing work, the workers do their working work, their work at their level. So Then I propose that managers should focus on planning and supervising work, which is basically a managing function, while workers should execute the task. Workers should what? Ensure that the task given to them by the manager is being executed well. So this session enhances productivity and accountability. So with that one, we're able to ensure that what everybody is accountable for what they're doing. So those some of the principles or techniques of scientific management by what? By Rick Taylor. So I think we can have a break for 10 minutes. Let's meet here at 1:10 to finish the other part. So let's have a small break, then meet at 1:10. Small break, please. Yeah, now so the next question here. Next question is asking, as a function of management, evaluate 5 principles of organizing. So basically, you know that organizing is one of the major functions of management. So organizing is one of the major functions of management. So, so that as a function of management, evaluate 5 principles. So what are the principles of organizing? What are the guidelines? Principles, basically guidelines. If you're organizing, what are some of the guidelines that you're supposed to follow? That's basically what we're talking about here. So the first principle is division of labor. So in organizing people, we ensure that we divide labor so that accountants do the accounting job, HR do the HR job, sales and marketing team do their marketing and sales team. So tasks should be divided among individuals and departments based on their specialization and skills. This promotes efficiency and productivity. So that's one. You need to what? Divide the work. Number 2 is what? Authority and responsibility. Another major function of management is what? Authority and responsibility. So means what? Once you give somebody work to do, then basically give them what? Give them authority so that what they're able to do the work. So they can only make somebody responsible if you give them what? Authority and resource. Each employee should have a clear understanding of their authority to make decisions and be held accountable for their actions. Balance authority responsibility relationship reduce what? Confusion. So if you're able to have a good balance of authority and responsibility, then basically, so if for you to be good in organizing, you must be somebody who has got what? Good authority and responsibility. Number 3 is what? Unity of conduct, unity of command. Unity of command. So an employee should receive orders from only one superior to avoid confusion and conflicting instructions. So in carrying out your organization, ensure that what? There's only one person who gives command to employees, because if employees are receiving command from different power centers, then basically they are going to be confused. At the same time, they may end up what? Not doing the right thing. Then number 4 is span of control. Span of control, we say that this is what? The number of people or number of employees that a manager can be able to what? Control effectively. So this limit of number of subordinates a manager can effectively supervise. A proper span ensures proper efficient communication, and so ensure that what? Each and every manager, when you're locating, organizing people maybe in departments, ensure that what? The manager there has a reasonable number. Don't give them so many people, because what? If they are managing so many employees, they're not be able to what? Achieve the objective. Now, question 4 is more of a, looks like a case study question. So we start by reading the case. This question 4A. Say that Jack Jim, this guy is JJ. Jack Jim, a champion and well-renowned organization change agent, joined PQX Company Limited as a chief executive officer when COVID-19 struck the world in 2020. In his first week after appointment, he called a meeting for the top-level managers in the company to brainstorm on changes expected in PQX Company Limited in order for the company to remain afloat. So he came up with what? He decided that, okay, let me, because I've been appointed when the company is facing a challenge, we're in the COVID era, said that let me call the top management of the company, help them understand or brainstorm on how or which changes they can bring to the company to ensure that the company remains afloat. At the same time, employees also are served. Now, part A of the question required, explain the term change agent. Who is a change agent? So we need to define a change agent. So we say that a change agent is an individual or group that facilitates and drives transformation within an organization. Means what? This is what? A change agent can be an individual or a group So you can be many people or one person. And this person must be what? Facilitating or driving transformation within the company. They are responsible for initiating, managing, and implementing changes to improve performance, increase awareness. So basically, they do that. So the definition was that what? This what is an individual or group that does what and drives transformation within the company. That's called what? That's called a change agent. Now, Roman 2 of that question say, analyze 3 issues that that the meeting might have addressed. You see, this meeting is happening during the time of COVID-19. So you're now being asked, in this meeting that was called between 𝐎𝐍𝐋𝐿 and top level management, what were they discussing? Or what could have been the agenda of their discussion? Number one is business continuity plans, because COVID-19 really interfered with the businesses. So one thing is what they had to discuss: how can we ensure that what we still be able to continue with this work irrespective of what. Number two is financial stability measures. How can we ensure that what, irrespective of what is happening now, we still remain financially stable? So we talk about what financial stability measures that are put in place. And then number three is what, health and safety protocols. Basically, during COVID-19, there were issues of mass, issues of social distance, issues of drugs that were being used. So basically, they also discussed, for example, ensure employee safety through implementation of health guidelines, sanitization, and employee wellness programs. They must ensure that what. So those ones were able to help them what? Help them work, or help them what? Help them sail through during that difficult time of COVID-19. So we talk about what aspect of health and safety. So those are the major, but those are not the only thing. They also discuss so many things. Maybe issues to do with what issues to do with what, maybe working from home. They talked about working from home was an issue that was discussed. So that what they don't have a lot of congestion in the office. So working from home could also be an issue that they discussed. Another issue they discussed maybe on sustainability. Sustainability is basically about continuity. So basically, those are some things they could have discussed. What do you think they discussed? What do you think these people could have discussed in this COVID-19 area? When 𝐺𝐻 came and he called a meeting during this time, what do you think some of the things that they could have discussed again? Anybody an idea of what they could have discussed? I'm giving you 1 minute. If somebody has an idea, you can put. If there's no idea, we'll proceed. Yes? Somebody? Oh, vaccination of employees. That's true. During that time, there was a vaccination. Maybe they discussed that in case you've not been vaccinated, they would urge you to what? Go get vaccinated. So basically, they would also discuss issue of what? Vaccination of employees, so that those who do not not been able to vaccinated, then basically they need to what? To go for vaccination. So that's another thing that we could have discussed. Any other points? If there's no any other points, we can proceed. Next question here is asking, evaluate 5 strategies leaders might apply in action to increase their leadership influence. So if you're a leader, what can you do to ensure that what? You make yourself more influential as a leader. What do you do to ensure that you become, or you are more influential? What can you do to improve your influence or to increase your influence? Number one is what? Leading by example. If you want people to respect you, then basically lead by. If you talk about people should come to work on time, can you show that? Be the first in the office. When you talk about this is a corruption-free zone, People should not see you accepting bribes. So basically, so leaders in peace flesh by what? Demonstrating integrity. So if you talk about integrity, that what? Employees should be people of integrity. Now, can you show us? Can you show it? Accountability. So basically, lead by example. Number 2 is what? Effective communication. Communicate to let employees know what's happening. So proper communication will also be a very, very important word or issue word. So clear, transparent, and accountable communication builds trust and fosters alignment between leaders and team. So basically, ensure that enhancing influence across nations. So that is very important. So those aspects are very, very important in that case. Number 3 is what? Empowering employees. Employees will respect you, or employees will look at you like a good leader when you look for ways to empower them. You make them, or you make them, you empower them. That is very, very important. So empowering employees becomes also one. Then building relationship with and what? Networks. Ensure that what? Ensure that you build relationships with employees. So strong interpersonal relationship with peers, subordinates, and stakeholders help what? Leaders gain support. And so basically, if you have a good relationship with your employees, the subordinates, then basically you win them, build more trust in them. Another one is what? Visionary leadership. People will respect you or will look at you like very influential. If you have a vision, that you tell them where the company needs to be. You are trying to help them what? See how the company can move ahead. So leaders who articulate compelling vision inspires and motivate employees, aligning what? So if you talk to the employees about the vision you have for the company and then you have for them, then basically they'll respect you. They'll look at you like what? A very influential leader. So those are some of the ways in which what you can be able to what? Improve your influence in the company. And many others. Question number 5 is asking, describe the 𝐅𝐻𝐂 change management model. So we talked about the models of change. One of them was 𝐅𝐻𝐂, and 𝐅𝐻𝐂 was basically an acronym. 𝐅𝐻𝐂 was basically a short form, an acronym for various aspects. So let's look at 𝐅𝐻𝐂. So the 𝐅𝐻𝐂 model is a goal-oriented framework that guides individual organization change. It stands for awareness. So 𝐅𝐻𝐂 said that word, for you to be able to implement change, the first thing is what? Awareness. So understanding the need for change, an individual must recognize why change. So basically, must awareness. So for us to bring or implement change, we must be aware that the change is important or necessary. So awareness to both the manager and the employees about the need for the change. Then desire, the motivation or willingness to participate in and support. So basically, there must be also desire that the employees and management are willing to support the change. Then knowledge, number 3 is knowledge. So knowing how to change, this includes training, education, and information. So knowing how to change, how do you change? You can change through training, you can change through education and support. Then ability, the skills and behavior required to implement change. Ability, do you have the ability? Do you have the skill? Do you have the behavior that are able to help us what implement the change? Then vice what? Reinforcement. The last one R is reinforcement. So sustaining the change through recognizing rewards and continuous support. So basically, you reinforce, ensure that what? Those changes that have been done, you implement them, you ensure that what you continue having them for long. The B part of this question is asking, explain 4 challenges associated with what? Group decision making. Up there, in the last paper, we looked at what's called what? We talk about types of biases. Now, some of those biases can be changed. So, explain 4 challenges with group decision making. If we are making decision as a group, what are some of the challenges we like to face? Number 1 is groupthink. Means sometimes we may just agree to ensure that people move ahead. We may not want to dissent. I may have an idea. I may have an issue that I think should say, but I say that nitakuwa na hinda group position. Number 2 is time consuming. Agreeing as a group is difficult. When you have 10 people, 12 people, some of them, for you to reach a consensus, you may take even 1 week. It is a decision. Then number 3 is what? Domination by one member. So there are some people who are very talkative. Some people can dominate meeting. They say they talk, but others are quiet. So basically, talk about domination can be another challenge. 4 is what? Conflict and disagreement. In discussing issues in a group, sometimes conflict arise, conflict of opinion, of ideas, and even physical conflict. A few that have gone and fought physically in meetings. So basically, those are some of what? The challenges. Next question here is asking, summarize 6 benefits. Summarize 6 benefits that may accrue to a nation from registering a trademark of their invention. So today, if we invent a good service, just a minute. Today, if, for example, we invent something new, what benefits we get to go and register it? Number one is what? Legal protection. When you register it, then what? Nobody can use that trademark. So a registered trademark gives the company a right to use the mark, protecting it from what? Infringement. So nobody can use it without your authority. Then brand recognition. So it helps establish a unique identity in the marketplace, enabling what customer do is basically if you register something, a trademark, then it becomes nobody can register the same thing. So people will be able to identify it in the market. Then competitive advantage. So trademark increase barriers for competitors and strengthen brand positioning, lead what? A market leadership. Basically, competitive means what? Once you register a trademark, it bars people from what? Using the same trademark. So they can only register others but not yours. And then second generation. So trademark can be licensed or franchised, generating what? Income for the company. For example, you can license so that when somebody wants to use your trademark, you license. For example, you've seen people using Total, 𝐎𝐿𝐒𝐋. Those are basically trademarks. So that you want to use our name, pay for something small, then use our name. So that's called what? Revenue generation. So some people pay for the trademark use. Then asset value. So trademark is an intangible asset that adds value to the company, especially during merger. So basically, if you have a strong trademark, a strong brand, then it's a value. Today, if you want to go and buy Apple brand, basically it's a value. Then that name alone. Then customer loyalty trust, basically their customer that word will be loyal to your brand. If you register brand means what? So basically, when you have loyal customers, means they come buy again and again, and then what? You're able to improve and get more profit. So basically, that's another reason why trademarks are important. Any question on that last question 5? Any question on area they need me to elaborate on? Any question? Number 5? Any question? Dorcas, Ondieki? Molinga, any question? Molinga has no question? Ondieki? Now, what happens in this one, Ondieki? That question you're asking, that how does this come in? I see it. What happens is that, you see, if you have a good trademark name, then there's what's called franchise. Some company, for example, you've seen this one, KFC, Total. Those ones are individual companies. These are Total. Those companies, those filling station ni ya watu. Kama mimi naweza enda ni tengeneze filling station, or niende niulize Total company to give me to use their name. So that name is sold. Hiyo jina peke yake inauzwa. Hiyo Total litumie, hizo kala zao, brand name yao inauzwa. So basically, they get revenue from their name. But now they give you condition because of quality standard they set. Wanambia, if you want to use our Total as our shell, as your users, then you must construct your filling station to be like this one. So they even tell you the structure, the coloring, and even where to buy fuel. You cannot just buy fuel anywhere to take to a Shell police filling station or what, or Total. They ensure that what you buy a clean fuel, because if they give you their brand name to use, and then you sell to people polluted fuel, then people will say that what Total is selling what unpure fuel. So basically, they'll give you. So they sell those names. You see KFC. This KFC you see in Kenya here, they're not from the parent company. These are just Kenyans who have gone to them, applied for license, and then they told, okay, you want to use your name, our name, then these are how you operate. So they give you conditions, and then you pay them for using their name. So you see that name alone is a resource. I don't know if you understand that part, Ondieki. Are you being able to see that on the aspect of revenue generation, how it comes? That's how. So that means what? That name, when someone wants to use it, they pay for the name. The brand name they're using there, they pay for it. So basically, the company, if you have a good brand name, then basically it becomes what? It becomes very, very profitable. So I think we have 10 minutes time. So I think we can stop there for today. Let's meet again on Saturday. We proceed. So indicate where we have stopped. I'll add more papers. The most recent papers, I don't see them here. So I'll add them in the course of the week. So by Thursday, we should be having them so that we are able to what? Be able to continue. So if there's no question, we can call it a day. We'll meet again on Thursday at 6 in the evening. So purpose to attend. These classes are very important nowadays. Don't miss classes, please. Let's try to attend as much as possible. Unless you have a good reason for missing a class, try to attend the class. So you have a good evening.
and then paper is the subsidiary. You can see also we're given the date of acquisition. Then from there, I want us to go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐻𝐒𝐂𝐒 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐻𝐶𝐈𝐍 Limited, a public limited entity. Effectively, 𝐻𝐒𝐂𝐒 Limited purchased 50% of the equity shares of what? Of 𝐻𝐶𝐈𝐍 for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐻𝐶𝐈𝐍 Limited. 𝐻𝐶𝐈𝐍 Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement, because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐻𝐒𝐂𝐒 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount, with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of 𝐻𝐶𝐈𝐍. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually we said once the subsidiary company revalued the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you said in most of the questions for group account, you'll come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset approximated the carrying amount, with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by paper. Did the paper limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number two, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. And equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have, from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful life. And I hope you can see that within note 1. Can you see the remaining useful life? How many years? In note 1, remaining useful life. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful life of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge. should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand, because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told 𝐿𝐿 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained, that if you come across that information, that it is the policy of the group, it is the policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. The full goodwill what? Method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to 𝐿𝐿 Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to 𝐿𝐿, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by paper to 𝐿𝐿, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of sales. Group revenue and also group cost of what? Of sales. So then in the same point, we are told half of these goods were still held by 𝐿𝐿 Limited as at the end of the year, and the balance payable was still outstanding, and the balance payable was still what? Outstanding. Now, in that case, we have 2 adjustments here. The first adjustment is adjustment for unreleased profit and also adjustment for amount of intercompany debt. I want us, first of all, we compute the amount of unreleased profit, So unrealized profit on inventory. Remember, unrealized profit, we said arises whereby we have sales between the parent and subsidiary, and some of the goods sold to the buying company will not have been sold to third parties. In that point, we are told that this company, which is called Paper, our subsidiary, sold some goods now to 𝐿𝐿, but basically some of the goods remained in the inventory of 𝐿𝐿. They were not yet sold to third parties. We need to compute the unrealized profit, and this unrealized profit is always by the selling company. The selling company is this one. So this is unrealized profit by paper. So how do we compute this unrealized profit? We take the unsold goods times the gross profit margin. Times the gross profit what? Margin. That is the formula you need to remember. The formula for computing what? For computing the amount of unrealized what? Unrealized profit. So let's proceed and we compute the unreleased profit, basically by applying this formula here, we will take the unsold goods, and in that case, we are told the goods not yet sold at the end of the year were half. Half of these goods were still held in the inventory of Lock. The unsold goods would be half of the goods which were sold by paper to Lock, which is basically 500 million. These are the unsold goods. The unsold goods, we multiply that with the gross profit margin. The gross profit margin, is it given? No. What we are given in our question, we are given the gross profit markup. Gross profit markup is 25%, which is basically the same with a quarter. Which is the same with what? A quarter. So having this, can we be able to determine the gross profit margin? Who can tell us which will be our gross profit margin here? Our gross profit margin, I'm told by Gilbert, will be 20%. As a fraction, it will be equal to what? As a fraction, automatically that one would be a quarter. And then to the denominator, we add the numerator. It will be 1/5. So this one will be the margin, will be 1/5. So how much will be our unreleased profit here? So it will be half to 50, and basically that will be 50 million. So this unreleased profit number one, this will be deducted from the group inventory. In preparing our consolidated balance sheet, we will start from the group revenue. Number two, this one will also be deducted from the retained earnings of the selling company. The selling company is paper. That one will be deducted from the retained earnings of paper. And then in preparation of the consolidated statement of profit or loss, this one we have said should be added to the group cost of sales. Those are the three adjustments which will be made as far as that and his profit is concerned. So we are done with point number 3. But even before you move to point number 4, in the last part of that, point number 3, we are told and the balance payable was still outstanding. The balance payable was still outstanding. What is that? Balance payable was still outstanding. What is that? Who can tell us? Balance payable was still outstanding. Balance payable was still outstanding. Basically, that is the amount of intercompany debt. Now, if this company sells some goods to this, so it is obvious that this company, the parent company, should pay who? Should pay the subsidiary. But in this case, we are told the balance payable, was still what? Was still outstanding. So how much will be the balance which was payable? The balance payable. The balance payable should be what? The balance payable will be what? The balance payable here will be 500,000, 500 million, that is, because the amount of money which Lock Limited was supposed to pay paper was 500 million. So this amount is the one which amount to, or is the amount of intercompany debt. Amount of intercompany what? Debt. So in this case, it will be 500 million. So this one will be deducted from the group receivables, and also it will be deducted from the group what? Payables. Group receivables and group what? Payables. We move to point number 4, and we are told impairment review performed on 31st of March 2024, that is at the end of the year, basically revealed that both goodwill on acquisition and on paper limited and the interest in Caesar were unimpaired. So the goodwill on acquisition of this, the investment in the joint venture were not yet impaired. So no working which is required. Number 5, incomes and expenses of the group of the companies are deemed to have accrued evenly throughout the year. So that information is always given such that if there is something you need to apportion on time basis, or something you need to apportion, you apportion it on time basis. You apportion it on time what? Basis. And I think having said, there is something we need to compute before we proceed to prepare what is required. I want us to compute the goodwill on acquisition, because there is something we will compute there Let's first of all, we compute the goodwill on acquisition of this company here. Remember, I said we only compute the goodwill on acquisition of the subsidiary and recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated statement of financial position. So let's compute the goodwill. The goodwill on acquisition of this company, that is Paper, Paper Limited, Paper Limited. As per the information we have in note number 2, we are using the full goodwill method. We are using the full goodwill method, the full goodwill method. So here we need to have 2 columns, and our figures are in million of shillings. I hope you can be able to remember how we compute the goodwill using the full goodwill method. We start with the purchase consideration, which was paid by the parent company. The purchase consideration paid by the parent company. The purchase consideration paid by the parent company, this one is given within paragraph 2. Paragraph 1 and 2. Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment of 2,400 million. So the parent company paid the purchase consideration. The purchase consideration paid by the parent company was in 2 forms: the cash consideration, and I hope you can be able to recall, we say that this one do not have any special treatment. That amount, we are going to use it as 2,400 million. So an immediate cash payment of 24. And this one, if you go to the balance sheet or the statement of financial position of the parent, under the non-current asset, you should be able to see that amount. So the moment the parent company has paid some cash consideration in acquiring a subsidiary, that is accounted for as an investment in the statement of financial position of the parent. I hope you can see that, 24. And then we also have a deferred consideration. The deferred consideration. So the deferred consideration still in that paragraph 2, we are told an immediate cash payment of 24 and on 1st April 2024, and a further consideration of that 1331 million deferred until 1st of April 2026. No accounting entries have been made in respect of the deferred cash consideration, and LOC limited cost of capital is 10%. These are deferred considerations which we said should be discounted to its present value using the parent company cost of capital. So we are going to discount that to the present value. So we will take 1331, and basically we discount this to the present value by multiplying that with the present value interest factor at the rate of 10%. And basically for how many years? How many years do we have from the date of acquisition? 1st of April 2024. This is the date of acquisition. That consideration will be paid on 1st of April 2026. How many years do we have here? How many years do we have there? Yes, we have 2. We have the first year which will end first, or basically 1st April 2025, 1, 2. So for 2 years. So this one will be computed like this. We take 1, remember the formula here, 1.1 raised to power negative 2. Yes, basically that's how we discount this. 1.1 raised to power negative 2, raised to power negative 2, raised to power negative 2. That's basically how we are going to discount that. Times 1331. And basically that one is coming to 1100. Is that what you're getting? 1100? 1100. 1100. 1100. Is that what you're getting? Diana, is that what you're getting? Georgina, is that what you're getting? Is that what you're getting? Yes. Okay, so then this is basically the purchase consideration paid by the parent. And then now to this, what we need to do? We need to add the NCI at fair value. Remember, you're using the full goodwill method. The NCI at fair value, this one is given in note number 2. Is given in note 2. So the NCI at fair value is 860. 860. So we need to add those 3 values so that then we proceed and we less the net assets, which one? Acquired. And basically, I'm told that this one will give us 4360. 4360. Okay. So then to this, what do we need to do? To this, we need to proceed and we less the fair value of net assets which were acquired. So remember, you say that this is one of the items which the examiner will not have given you, and this whereby majority of the students have a challenge. How do we compute this? We say to compute this, we take the ordinary share capital of the subsidiary plus pre-acquisition reserves. Plus pre-acquisition reserves. So what we do, we have to go to the balance sheet of the subsidiary, specifically at the equity. Can we go to the balance sheet of the subsidiary? Subsidiary is paper, specifically at the equity. At the equity, we start by taking its ordinary share capital. Its ordinary share capital was, or is basically 2,000. Below that, what do we have? We have share premium. In this case, if you're given a share premium in the balance sheet of the subsidiary, and the question is silent, the question is what? Silent. We always treat that as a pre-acquisition. We always treat it as what? As a pre-acquisition. And then from there, we have the retained earnings. The retained earnings. But basically what we know is that that retained earnings which we have there, that is the retained earnings at the end of the year. So what we are interested with here is the retained earnings on the date of acquisition, because this is a reserve. This is a reserve. We're interested with the retained earnings on the date of acquisition. And basically what we know, I've said that the retained earnings which are given there of 1,800, this is the retained earnings at the end of the year, 31st of March 2025. So we are interested with the retained earnings of paper on the date of acquisition here, 1st of April 2024. How do we get that? Very simple. Because one, we know the retained earnings of this company for the current year. In other terms, what is the profit after tax of paper? So the retained or the profit after tax of this company during the current year. So you get that from the income statement. Can we go to the income statement of paper? The income statement of paper, you tell me how much was its profit for the current year. How much is the profit after tax for the current year for paper? Can you see that amount? It is 520. It is 520. So how do we arrive at this value here, the retained earnings at the end? To arrive at this, we take the retained earnings at the start, which we don't have. We add this, we get this. Sasa, we take this plus this, we get this. What we are interested with is the retained earnings of this date. So can we be able to get this? Take into account to get this, we take this plus this, we get this. It's very simple. So to get this one, we will take this minus this, we get that. So therefore, the retained earnings at the start will be 1,800 minus 520. And this will give us 12 what? That will give us 1280. 1280. So 1280 is basically the retained earnings on the date of acquisition. And therefore, if you check there, we don't have any other reserve. But in all this particular question for group account, there is something you must always remember to check. Did the subsidiary company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? Remember here, Paper Limited revalued the asset. There was a revaluation gain of 560, which we said is a pre-acquisition revaluation reserve. So we have a pre-acquisition revaluation reserve of what? Of 560. Yes, we don't have anything else. Let's get this total. Let's get this total. This will give us a total of what? This will give us a total of 40. So because you're using the full goodwill method, we take 100% of that. When using the full goodwill method, take 100% of this. We are interested with the net asset acquired by the parent and the NCI. Parent and the NCI. So this will give us 40. So we less it from the figure we have up there, and basically we get the goodwill. We get the goodwill. So our goodwill will be what? Will be 320. Now also you have to check, was this goodwill impaired? In our case, we are told as per the information we have in note number 4, the goodwill was not impaired. So I think having this now, I want us now we prepare what we are required. And because we have now the workings, all the workings, basically to prepare what is required should not take us a lot of time. So we go straight to part A, the consolidated statement of profit or loss. Let me just have that here. The consolidated statement of profit or loss, which is for the year, which ended 31st of March 2025. 31st of March 2025. Yes, so here we just need to have a single column, and basically we indicate that our figures are in million of shillings. So how do we prepare this? As per our group structure, we are basically combining the revenue and expenses of the parent, those of the subsidiary. We combine the revenue and expenses of the two companies. It is also important to note that this company, taking into account it was acquired exactly the start of the year, we will take the revenue and expenses of paper for the whole year. For the whole year, we combine with that of the parent. In our case, remember, we don't consolidate a joint venture. Instead, what we will compute is the parent company share of the profit after tax, and basically we recognize it what here. So let's do that now. So how to prepare this, we go to the statement of profit or loss for individual companies, which is basically given below paragraph 2. And we use the format which are given there. So we will start with the revenue. We take that of the parent, 520, plus that of the subsidiary, which is paper, 51.80. So remember, we are not consolidating their joint venture. So and then to this, what do we need to do? We need to less any sales between the parent and the subsidiary. And I hope you can remember you have this intra-group trading of 500 million. We less it here. No any other adjustment. No any other adjustment. We get the final value. We try to hurry up so that we finish. Although I can see we have time. We have time. So once you get the answer, type it in the chat box. I'll be able to see it. So I'm told that will give us 13,200. 13,200. Someone else to confirm. Is it 13,200? Is it 13,200? Is it 13,200? Yes. So then below that, we take the cost of sales. We do the same. 5510 plus 3440. So to this, we have a number of adjustments to be made. One, we less this amount of intra-group trading, 500. So we also have this depreciation. Okay, this one will not be adjusted to the cost of sales, but rather to the administrative. We have this and this profit of 50 to be added there. And I don't think we have any other adjustment. So we get the final value there. The final value. Final value, I'm given 85. I'm given 85. Okay. So we move and basically we compute the gross profit. So the gross profit here will be how much? How much will be our gross profit? The gross profit will be 47. So then to that we proceed and basically we add the distribution. I think before we add the distribution, we can do this. We need to compute the group share. The group share of Sisters Limited profit after tax. Remember, this is basically a joint venture. That's what we include here as far as the joint venture is concerned. So what we need to do, can we go to the income statement, to the statement of profit or loss of Sisters, and you give me its profit for the year or the profit after tax. The profit after tax for Sisters is how much? Is it 640 million? Yes, 640. Now, then we need to determine when was our joint venture acquired. You can see the date when it was acquired, this date here. 1st of October 2024. This is within the current year. The current year is ended The year ended, the current year ended on 31st of March 2025. How many months do we have here? Are they 6? So we have October, November, December, January, February, March. 1, 2, 3, 4, 5, 6. So in this case, we have how many months? Yeah, are they 6? Are they 6 months? Do we have 6 months? I've said 1st of October, 2024. So our joint venture was acquired 6 months to the end of the year. So the parent company will only be entitled to share profit from the date it acquired that joint venture. It will only be entitled to share profit for how many months? 6. That's why we have to compute profit of 6 months, and then we multiply that with the parent company shareholding in CSAS, which is 50%. That gives us now the group share of CSAS limited profit after tax. You think this one should be 160. This one should be 160. And then from there, let's proceed with the expenses. The first expense we have there is the distribution cost. And I hope you can be able to recall that if you come across these always are 3 mark. No single question for group accounts will come across whereby the distribution cost is to be adjusted. These always are 3 mark. We take 830, that of the parent, plus that of the subsidiary. No adjustment. We get the total, which will be 1,300. Which will be 1,300. Are you getting that here? Yes. So then below that, we have the administrative expenses. Administrative expenses, we take that of the parent, 860, plus that of the subsidiary, 520. And then to this one, we have to add this depreciation other charge of 70 over 70. Also, in case our goodwill was impaired, in case this goodwill was impaired, any impairment loss for the current year, we also include it within administrative expenses, but we don't have any impairment loss. We get the final figure, which will be what? Which I'm told is 1450. 1450. Is it 1450? Yes. So then below that, we don't have any other expense. Okay, there is something we will include here. That one, you have to be very, very keen to remember that. Because I hope you can be able to remember, we have this deferred consideration. You see this deferred consideration, basically this represents what the parent company would have to pay at the end of the second year. So therefore, once we have discounted this deferred consideration to its present value, we have to amortize it. In the process of amortizing a liability, there is something which arises, which is known as interest. If you're amortizing a loan, if you're amortizing even, for example, financial liability, there is something which is known as what? Interest. So that interest is basically recognized here as part of the finance cost. So the finance cost will basically be the interest on this deferred consideration. How do we compute that interest on the deferred consideration? On the deferred consideration, we take this amount which you computed here, the present value of the deferred consideration. And for us to be able to compute the amount to be recognized as an interest during the current year, we multiply this with the rate which you have used to discount, which is 10%. 10%. So this will give us 110. Now this 110 is the interest on deferred consideration. Interest on deferred what? Consideration. And then this interest basically should increase the value for this. So what I'm trying to avoid here is basically to prepare a amortization schedule, but I think I can do that very fast so that you understand. Amortization schedule. We are saying we should amortize this. You see, this is the deferred consideration at the start. This is like our own amortization schedule. You have a column for years, the liability at the start, the interest, the cash paid, and the liability at the end. No need of doing that because we know what we want to do. We want to compute the interest, which will be 10%. And then, is there any cash paid during the current year? No, no cash paid. So therefore, to compute the liability at the end of the first year, we take this plus this. Can you add for me that? So that you understand what we amortize this. So that will give us 1210. So in fact, when preparing our balance sheet, this is the value of our deferred consideration. The deferred consideration is a non-current liability, and that is its value at the end of the year. Then that would be the opening balance in the next year. And then we compute the interest, which is 10% of this. Will it come to 121? Is that what you're getting? Yes. Now we know the deferred consideration, this one, will be paid at the end of the second year. So at the end of the second year, the company will pay 1331. And once you do that, then you should get 0 there. You should be able to get 0. Will you get 0? Yes. Are you getting 0? Yes. So this is how we amortize that word. That. So basically, in relation to this deferred consideration, 2 items. One, this interest is part of the finance cost here, which is 10% of 1100. And then when preparing our consolidated statement of financial position, this one will be recognized as a non-current liability. Sasa? Yes. So having that, then we can proceed and we compute the profit before tax. Give me the profit before tax now. The profit before tax down here. How much would be a profit before tax? This plus this minus the 3 expenses there. I'm told this one will be 2,000. I'm told that one will be 2,000. Will be 2,000. Then we less the other item, which is also always a free mark. Income tax expense. Income tax expense, also this one, is always a free mark. A free mark. So no question for group account whereby income tax will be having adjustment. You take that of the parent and that of the subsidiary. And this will give us what? This will give us 670. 670. And basically we get what? We get profit for the year. Profit for the year, which will be 680. Which will give us which will give us what? 1320. Yes. So basically in our case we are done, and that what was required. The marks allocated there were 10. So this basically what was to give you what? 10 marks. You can see in that question, it basically means that for any correct item which you had here, basically should be 5 marks, because these 6 cannot be 10. Yes. So having that, let's move to part B. The consolidated statement of financial position. Consolidated statement of financial position is at 31st of March 2025. Okay, so we prepare this one. We just need to have a single column here. And what is basically important for you to remember is that here, or this one is basically prepared by just combining similar items of assets and liabilities, those of the parent and those of the subsidiary only. As far as the associate is concerned, CSAS, we will include something called the investment in associate. So let's prepare this one. We start with the non-current assets. So for the non-current asset, we will start with the PPE, the property, plant, and equipment. So, and basically we take that of the parent 4260 plus 3660. And then you have to recall, we have an adjustment to be made to the PPE in relation to this working. So we said this 560 will be added to the group PPE, and then this depreciation other charge of 70 will be deducted from the PPE. 2 adjustments here. 2 adjustments, we add the revaluation gain of 560, we less the depreciation other charge of 70. We get the final value there. The final value will be what? What will be the final value? The final value, I'm told by Gilbert, will be 8380. 8380. That is the same figure I'm getting from Diana. So then from there, below that, we have investment in paper, investment in CSAS. Remember, these are the purchase considerations which were paid by the parent company in acquiring shares of CSAS and paper. Do you include that here? No. In relation to the subsidiary, which is paper, what we include here is the goodwill. We include the goodwill on acquisition of the subsidiary, which is paper limited. And basically that's what we computed here, 320. 320 In relation to CSAS, which is the joint venture, we compute something called the investment. The investment in joint venture, or basically joint arrangement. I just refer to it as the joint what? The joint arrangement. And basically we recognize that here is an item of what? As an item of non-current asset. I want us to have the working here, because remember I've given you the format for computing this. How do we compute the investment in associate or joint venture? I said one, you take the purchase consideration which was paid, or the cost of investment. That is basically what we have within the statement of financial, or within the statement of financial position of the parent under the non-current asset. How much purchase consideration was paid by the parent company in acquiring the shares of the joint venture? That is 15. That is 15. And then to this we have said we add what? To this we have said we add the group share of the joint venture post-acquisition retained earnings. And basically take into account our joint venture was acquired during the current year. CSAS was acquired during the current year. The amount which we include here, which we have included here, that is now the same with the group share of the post-acquisition retained earnings of the associate. That is basically what we will add here, 160, this one. And then to this we less any impairment loss. And I hope you can be able to recall in note number 4, we were told that in note number 4, you are told the goodwill on acquisition, the investment in associate had not impaired. They were unimpaired. So we don't have any impairment loss. And that will give us what? 1660. That will give us 1660. So that basically what we include here. Then from there we proceed, and basically we record the current asset. So for the current asset, we are given the total. We will take that is 720. That is of the parent plus that of the subsidiary, 2270. And then in this case, you have to recall that inventory, receivables, cash, and bank balance are part of this. Any adjustment affecting this inventory and receivables should be made here. And I think you can be able to recall here, we have this and this profit, which we said should be deducted from the group inventory. Inventory is part of this. So we less and there is profit of 50. And also we have the amount of intercompany debt, this one, of 500. We also less it here. I don't think we have any other adjustment. So let's get the final figure. We get the final figure. I don't think we have any other adjustments. So what is the final figure here? I'm given 50, 440, 5440, 5440. Yes. So then what will be our total? What will be our total assets? What will be our total assets? You add all this, you give me the total assets. And because of space, I want to do away with this one. I want to do away with this one. Yes, the total asset in our case will be 15,800. I want to do away with this now. Yes. So then from this, we need to move. And basically, we record equity. So for the equity, we will start with the ordinary share capital. Ordinary share capital. And I hope you can be able to recall the ordinary share capital. We don't consolidate this. We only include the ordinary share capital, that of the parent company only. The ordinary share capital of the parent company only, which is how much? Which is 5,000. 5,000. Below that, what do we have? We have share premium. Equally, the share premium, we basically include that of the parent company only. That of the parent company only, which is 500. So below that, we have what? We have the retained earnings. So basically, retained earnings is one of the item which is a little bit tricky in terms of its computation. Maybe first of all, we can skip this one. We will come back and compute it. Then we will get what? we will get the total equity. We will get the total equity. And I hope you can also be able to record your thought in a part. These are some of the items you don't have to compute in an exam. They'll consume a lot of your time, and you end up maybe getting that figure wrong. So, but we will come back and compute. We will compute that. Then down here, after getting this, we also come and we compute something called the non-controlling interest. I'll be able to explain what is this in the process of computing that, but we will compute this as the last two items. Then from there, we need to proceed and we record liabilities. I think for liabilities, we have the current liabilities, but in this case, there is something we are going to introduce. We are going to introduce non-current liabilities. I hope you can be able to remember this deferred consideration. These are consideration to be paid by the parent company in future. So that deferred consideration will be recognized here as a non-current liability. And basically, I've said the value for deferred consideration at the end of the day is this one. We have amortized that. So this amount plus the interest for that year, which will give us what? Which will give us 2110. And then finally, we have the current liabilities. Current liabilities, we take those of the parent 3,000 plus 19, those of the subsidiary. And then you have now to record that these include payables. Payables, we have amount of intercompany debt, which should be adjusted from the payables, this one, 500. So that one should be deducted here, 500. So give me the final figure. Give me the final figure here. The final figure for payables for current liabilities. For current liabilities, I'm told is what? 44. Yes, 44. 44. So what I want us to do, I want us to compute these two items here very fast. Very, very fast. We should be able to do that in the next 10 minutes. We should be done. Yes, so we can start by computing what? Let's start by computing the group retained earnings. But basically, I've said, if, for example, you're doing that question in an exam and basically you leave it like that, you should be able to get all marks. You should be able to get all the marks. So let's start by computing this one. The group retained earnings at the end of the year, that is carried down. That is carried down. That is carried down. So how do we compute this one? How do we compute this? So the first thing maybe you need to remember is the formula. How do we compute this? So this one is computed by taking the 100% of the parent company retained earnings plus for this company here that is paper, we should take 80% of a post-acquisition retained earnings plus 50% of sisters. I've said 80% of paper limited post-acquisition retained earnings plus 50% of sisters limited post-acquisition retained earnings. Yes. That's basically how we compute that. So what basically we should do is to have 3 columns for our companies here, starting with the parent, which is log, the subsidiary paper, and the joint venture sisters. And basically in this case, we will take what? We will take the retained earnings as given in the statement of financial position. So we go to the statement of financial position, we take the retained earnings balance carried down as given in the statement of financial position. So can you go to the statement of financial position of these 3 companies, specifically at the equity? At the equity, we are given the retained earnings of log, that is 380. For paper, it is given as what? 1,800, and for sisters is given as what? is given as 12. So the first thing we need to do for these two companies, we are interested with the post-acquisition. So what we need to do for these two companies is to less the pre-acquisition. Acquisition. That does not apply to the parent. It only applies to these two companies. That's yes. And I think for this, what we will do, for this company, I think we computed the, for paper, we computed the pre-acquisition. The pre-acquisition retained earnings, which we have used in the computation of goodwill. How much was it? Give me that figure. We have computed the pre-acquisition retained earnings for paper. That is something you have already computed. Who can give me that figure? That retained earnings in tulitumia ku compute goodwill ya paper. Was it 1280? The one at the start? Yes. So this one we said is pre-acquisition. Is that the case? So pre-acquisition ya hii ni 1280. So we will less it there such that we shall be left with the post-acquisition. And then what about the scissors? Scissors, when was it acquired? I hope you can remember when scissors was acquired. Scissors was acquired 6 months to the end of the year here. Was acquired 6 months to the end of the year. 6 months to the end of the year. Basically, for scissors, we need to have, first of all, its retained earnings at the end. Its retained earnings at the end for scissors is 12, the value which we have here. Let's be together here. And then we also need to have the profit for scissors for the year. That one, we get it from the income statement. From the income statement, the profit for the year for scissors is 640. Silio? Yes. So can we first of all get the retained earnings here at the start of the year? So to get the retained earnings at the start, we will take this minus this, we get this. This minus this, we get this, which will give us what? Which will give us 560. So can we be able to get the retained earnings of scissors on this date of it was acquired? Just like how we computed this. It's quite simple. To touch this one at the start 560, and then we take for the whole year, which is 640. And here, because we have 6 months, we get half of this. We multiply that with 6 over 12. So we take 560 plus 320 plus 320 plus 320. That will give us what? That will give us, I hope you can see what I've done. I've taken the retained earnings of scissors at the start, which you have said is this, minus this, which will give us 560. And then for me to compute its retained earnings on the date of acquisition, which is pre, I've taken the retained earnings at the start plus the profit for the year for this 6 months, just like what we did for the subsidiary. So, and I'm told that will give us 880. So now we get the post. Basically, I've said this does not apply to the parent. So what do we get here? Because of time and try to hurry up, what do we get here? We get what? 520. What about this one? We get 320. We get 320. Yes, 320. Then before now we apply these percentages, because this one we should take 100%, this one 80%, this one 50%. There are some of the retained earnings here we need to be adjusted. As per the workings which you have done here, number one, we have this depreciation other charge, which we said should be deducted from the retained earnings of this company. So we have depreciation other charge to be deducted from the retained earnings of paper, which is 70 there. So this and this will not affect that, but we have this and it is profit, this one. We say this one will also be deducted from the retained earnings still of paper. So we have and it is profit that will also be deducted from the retained earnings of paper, 50, like that, like that. Do we have any other adjustment? I can't see any other. So we need to get the final figures, that is 380, this one 2400, this is 320. And then we get the group share of this. The group share. We apply now these percentages. This one for the parent, we take 100. For paper, we take 80. And for this company that is the sisters, we take 50. We take 50%. 50%. So this will be 160. This will be 320. This one will be 3380. And then we add these two. We add those three values. We add those three values. That will give us the group retained earnings. The group retained earnings. I'm told that will give us 38.60. Basically, you can see how the computation for this is quite demanding. And that's why I'm saying, for example, if you're doing this question in an exam, I will not advise you to do this. I will not advise you to compute this. Yes. So maybe first of all, you can get the total equity before computing NCI. So this will be 55 plus 38.60, which basically will give us 93.60. Finally, we compute the NCI. So the NCI is what? We'll talk about the NCI basically. This refers to the amount of money which is invested by the minority shareholders in the subsidiary. The capital invested by the minority shareholders in the subsidiary. Amount invested by the minority shareholders in the subsidiary. How do we compute the NCI at the year end? To be recognized there as a component of equity. Now to compute this, very simple. We take the NCI at fair value. The NCI at fair value, which is basically given in note 2. The NCI at fair value in note 2. How much is the NCI at fair value? The NCI at fair value in note 2 is what? Is 860. 860. I hope you can see that. And then to this, what we add here is something called the NCI share. NCI share log the post that is of the NCI share of adjusted post acquisition retained earnings in the subsidiary company. So the NCI share of the post, that is the NCI share of the adjusted post acquisition retained earnings in the subsidiary. So where do we have this figure? The adjusted post acquisition retained earnings of the subsidiary. So that is basically the figure which we have here. This is the adjusted, this is the adjusted post acquisition retained earnings of the subsidiary. Which is how much? 400 million. So we get the NCI share of that. The NCI share of this will be 20%. Will be 20%. 20% of that will give us what? That will give us what? That will give us what? Is it 80? Yes, it will give us 80. And then now to this, in case, for example, we had an impairment loss, the goodwill on acquisition was impaired. What we left here is the NCI share of impairment what? Loss. Was the goodwill impaired? No. No item to be deducted there. So we add these two values and then give us 940. So the NCI fair value here is basically 940. But basically I'm saying if, although these are some of the tips we will be able to discuss in the during our revision. So whenever you're doing that question in an exam, I will not advise you to compute this and this. Because even without computing those two items, you'll have scored all the marks. Is our statement of financial position or balancing? It is not balancing, that is what I'm told. What is the difference? What have you omitted? Ten. Or 10 bob. 10 bob. 10 bob is, where do we have that? Where do we have that 10 bob? Yes, I think it is. That one should be, is it interest? The interest on deferred consideration. No, that one is captured there. That one is captured there. That one is captured there. So you're saying the difference is there. What is the difference? Is the difference, is it 110? 110? Yes, I know where that one should be captured. That one basically should be deducted from the retained earnings of the parent here. Because that is an interest or is basically an expense which the parent company was supposed to have accounted for. But if you check on the income statement, the parent company had not accounted for the interest on this. So that one should also be adjusted here. The interest on deferred consideration, it should be deducted from the retained earnings of the parent. Deduct that here. Deduct that here. It was supposed to be accounted for as an expense by the parent, but the parent company had not accounted for that in the income statement. Was it accounted for by the parent company? No. So that's why it should be deducted there. 33, 80 minus 110. So now this one should be 92.70.
Issues. These are the things that you can easily understand. So the question says, Blades Limited is considering diversifying its operations away from its main areas of business, food manufacturing. So these people, and I said, always ensure you understand the context of the question. Just get the story first. Get the story first. If you get the story first, then it becomes very easy for you to understand what? The calculations, and also for you to get the concept. So try to understand the story that we are being given here. So Blades Limited is considering diversifying its operations away from its main areas of business, food manufacturing. So currently they are in food manufacturing, into the plastic business, and they want to venture in the plastic business. The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. So the company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. The project is expected to produce net annual operating cash flows of shillings 220 million for each of the 3 years of its useful life. The project is expected to produce net annual operating cash flows of 220 million for each of the 3 years of its useful life. Its salvage value is 0. The assets of the project will support debt finance. The assets of the project will support debt finance of 40% of its initial costs, including issuing costs. So we are saying that that 450 million will be formed by 40%. 40% will come from our debt. The loan is to be repaid in 3 equal annual installments. The balance of the finance will be provided by planning of new equity. Issue costs will be 5% for the equity and 2% for the loan. So the issue costs we've been given there. Debt issue costs are allowable for tax. Debt issue costs are allowable for tax. Then the plastic industry has an average equity beta of 1.368 and an average debt to equity ratio of 1:5 at market values. Blades Limited's current equity beta is 1.8, and 20% of its long-term capital is represented by debt, which is generally regarded to be risk-free. The risk-free rate is 10% per annum, and the expected return on an average market portfolio is 15%. Corporate tax is at 30%. The machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life and will be allowable against tax. The firm is certain that it will earn sufficient profits against which to offset these balances. Then required, using adjusted net present value, advise whether or not the project is worthwhile. So using adjusted net present value. So now, using the net adjusted present value, to start with, we are supposed to compute what? The base NPV. So the base NPV is just, you just compute the normal NPV of the project, but this time round, using the cost of equity. So we'll start, so write step one. We are going to do it in steps. So step one, compute the cost of equity of the company. Compute the cost of equity of the company using CAPM. Compute the cost of equity of the company using CAPM. Compute the cost of equity of the company using CAPM, Capital Asset Pricing Model. So here we start with the cost of equity. So step one, cost of equity. Cost of equity, Cost of equity. Now, if the cost of equity was given, we would not have computed. So we would just have gone to step number 2. So we are using this formula. We're using this formula to get the cost of equity. We're using this formula, the CAPM formula. So risk-free rate has been given. Risk-free rate is what? We are told the risk-free rate is 10%. And the return on market portfolio is 15%. Return on market portfolio is 15%. Then beta of equity, we don't know. Beta of equity, we are going to look at that. I want us to go back to the point where we are talking about betas. The paragraph where we are talking about the betas, that should be the last paragraph, where they're saying the plastics industry has an average equity beta of 1.368. 1.368. Remember, this company, Blades Limited, they are currently in the food manufacturing industry, but now they want to venture in the business, the plastic business, And now we want the cost of equity that will be relevant to evaluate a project in the plastics industry. So one thing that you're supposed to note is that the relevant beta is the beta that relates to the plastics industry, because that is the industry that we are venturing in. We said beta represents the market risk in a certain industry or sector. So here, for us to compute the cost of equity that is relevant to evaluate this particular project, we need to get the beta of equity that relates to the plastics industry. So the relevant beta here is 1.368. The plastics industry has an average equity beta of 1.368. So forget about the beta in the food processing, on the food manufacturing. And again, at an average debt to equity ratio of 1:5. Debt to equity ratio is 1:5 at market values. Now, the most important thing here to note is that the question tells us that Blades Limited, they want to finance using 40% equity and how much? 60% equity. Because if you go back there, up there, there is a statement that says, which says what? there is a statement which says, paragraph 2, the assets of the project will support debt finance of 40% of its initial cost. So we are going to have 40% as debt, 60% then will be equity. But note, if you look at the debt to equity ratio of plastic industry, in the plastics industry, debt to equity ratio in plastics industry is equals to 1:5. So this beta, then beta of equity in the plastics industry, no, let's say this, say plastics industry. I want us to analyze this so that you can understand. Plastics industry is saying beta of equity in this company, and this beta is levered. This beta is levered. The levered beta in the plastics industry is 1.368. 1.368. Then debt to equity ratio is equals to 1:5. Is equals to 1:5. So this beta of 1.368 is geared using this ratio. So if we were to rewrite this, this would be what? 1:5. 1:5. If we write this into fractions, it will be debt will be 1/1 plus 5. Is it 1:5? Sorry. 1:5. So you're saying, yeah, 1:5. Yeah, 1 plus 5. Then equity should be 5/1 plus 6. 1 plus 5. Exactly. So this is 1/6. So debt, okay, let's have it here. Let's have it here. 5. Okay, just a minute. Let's just get this 1/6. So definitely this will be 5/6. So 5/6, yeah. So it's 5/1 plus 5, which is equals to 5/6. 5/6. Get this in decimal places. Get this in decimal points now. And you try to hurry up. Okay, yeah. But this is not even that important, but just get it. 0.17, 0.17, and 0.1.7, 0.83, yeah. 83. So that is how you get the fractions from this. But now, what is my point? My point is, this is what we have in the plastics industry as debts and equity. But this is what we have in Blades Limited. This is how Blades Limited wants to finance their project. This is what we have in the plastics industry. So it does not mean that if you go into a certain industry, you must adopt the financing model that is there. No. What you can only adopt from that industry, it is the beta, because you cannot change the market conditions. You cannot change the market risk, but you can adopt your style of financing. So what you want to do now, well, the reason why we've been given this information is we are supposed to ungear. We are supposed to ungear this beta. We are supposed to ungear this beta using these weights and regear it using the Blades Limited's weights, using the Blades Limited's weights. So maybe you can put a note somewhere and say, that is not step number 2, just a note, say, the relevant beta of equity, the relevant beta of equity is the plastics industry beta. is the plastics industry beta? Is the plastics industry beta? Full stop and say, and gear the beta, and gear the beta, and gear the beta using the debt equity ratio, and gear the beta using the debt equity ratio in plastics industry, and gear the beta using the debt to equity ratio in plastics industry, the debt to equity ratio in plastics industry, and then regear, and then regear, and then regear, and then regear using Blades Limited, and then regear using Blades Limited capital structure. Blades Limited capital structure, or into brackets, financing model. Financing model. Financing model. No, so let's now ungear the beta. So you're aware, you know how we ungear the beta. Eh? So if a beta is geared, we said, to ungear the beta, you get the equity, you get equity, you divide by E plus D 1 minus T. That is how we ungear. That is how we ungear. So, this one, beta of the ungeared beta will be 1.368 times 0.83 over 0.83 plus, okay, we can still use 5. We can still use 5 and 1. 1 minus 0.3. Kindly get the beta. Get that beta. How much are you getting? Hey, my people, I think yours is wrong. If I'm not wrong, you're wrong. I'm getting 1.196. This is what I'm getting. This is what I'm getting. 1.196. Yeah, Diana, almost there. But okay, someone else. Hey, you people, why this? Why these differences? Because what are you doing? Just get 0.83, 0.83, you divide 0.83, you divide by into brackets 0.83 plus 0.17 times 0.3, close the brackets. So I think mine is okay. I don't know why I feel mine is okay. We proceed with mine, 1.965. Yeah, that is with some. Let's proceed. Or you can say, let's try this. 1.368 times 5 over 5 plus 1 minus 0.3. I think this one would be better for majority of us. So we divide 5 plus 1 times 0.7, close the bracket, times 1.368. Here you'll get 1.2, which is almost the same as what we have here, yeah? If you round off this, you are getting 1.2. So now we regear. We regear, and we say to regear, now we use the weights of the current company. So here we say this 1 times D 1 minus T over E. So we are using this one. So this will be 1.196. This is what we are gearing because this is the ungeared beta, times into brackets 1 times 0.17 times 1 minus 0.3 over E 0.83. Or let's use 1.2. Let us use 1.2. Let us use 1.2 for consistency. You can either use 5 here, 1 and 5. Just use what you want to use. So this will be, this is plus, sorry, this is plus, is it? This must be plus. This is plus. So this is where people get wrong with these formulas. Instead of adding, maybe you're multiplying, something like that. So this is 0.17 times, or let me use 0.17 times 0.7. You divide by 0.83, you add 1, then you multiply by 1.2. I'm getting 1.37. 1.37. Now let us regear now. Oh, no. We have now the regeared beta. We have the regeared beta. Let us get the cost of equity. Cost of equity is equals to 10 plus into brackets 15 minus 10 times 1.37 times 1.37. The cost of equity of Blades Limited. I'm getting 16.85. 16.85%. Now we have the cost of equity. That was the first step, computing the cost of equity. So we go to step number 2. Step number 2 say compute the base NPV. Compute the base NPV. Compute the base NPV using the cost of equity computed above. Compute the base NPV using the cost of equity computed above. Using the cost of equity computed above. So let's get the cost of, let's compute the base NPV. I'm going to do away with this. Kindly, if you have not written, you can screenshot. If you have not written, you can screenshot. Okay, fine. So to compute the NPV, we are just computing normally. So we start with the year. The project has a useful life of 4 years. So here we have 0. Let's start with year 0, 1, 2, 3, and 4. So the initial cost is for 50 million. Initial cost of the project is for 50 million, which is negative. That is what the question says, that the company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. Then the project is expected to produce net annual operating cash flows of 220. So we have annual operating cash flows, annual cash flows. So these are earnings before depreciation and tax. Earnings before depreciation and tax, 220 million. So we have 220, 220, 220, 220. Then next, let us tax. We less tax. We less tax. Tax is 30%. Tax is 30%. So 30% of this should be 66. Is it? Should be 66. If I'm not wrong. $66. Next, we want depreciation tax shield. Depreciation tax shield. DTS. Let me write DTS. If you know you are going to forget, kindly write in full depreciation tax shield. Depreciation tax shield. And the question says, let's go back to the question. The point where they are talking about depreciation. That should be in the last paragraph. The risk-free rate is 10% per annum, and the expected return on an average market portfolio is 15%. Corporate tax is at 30%. Corporate tax is at 30%. The machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life. So capital allowances is what we are calling depreciation. So here, say capital allowances, stroke depreciation. Year 1, now let's say depreciation tax shield. Depreciation tax shield for year 1 is equals to 70% times 450 million times 30%. So remember, depreciation tax shield is equals to depreciation times the tax rate. So here they are claiming 70% of the cost of this asset as capital allowances in year 1. So that's why we're saying 70% of 450 times 30%. So how much are you getting? How much are you getting as the depreciation tax shield? 94.5. 94.5. So this is a saving. It is the tax advantage that we are enjoying. So 94.5 here. Then the last one they're saying, the machine will attract a 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life. So the remainder, it's 10, 10, 10. So year 2, it will be 10% times 450 times 30%. Year 3, it will be 10% times 450 times 30%. And the last one, year 4, it's the same, 10% times 450 times 30%. 13.5, 13.5, 13.5. So you add 13.5. And you get the after-tax cash flows. You get the after-tax cash flows. Where are we getting 10? Where are we getting 10? 100 minus 70 for year 1, the balance is 30%. 30% we divide by 3, you will get 10, 10, 10, 10. Douglas, is that okay? 70%, yeah. 100 minus 70% for year 1, the balance is 30%. You divide by 3 because they're saying it will be distributed evenly over the remaining useful life. Now let's get this. So net cash flows, net cash flows. This is for 50, negative. Then the others. But let me ask, what is the useful life of the project? Is it 4 years or 3 years? Should be 3 years. Should be 3 years. The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs for 50 to 20 for each of the 3 years. Hey, it's 3 years, sorry for that. It's 3 years. So this now will change to 15. This 10 that we are talking about here will change to 15. This one is now 15, not 10. It's 3 years, 15. Kindly make that adjustment. Make that adjustment. The useful life of the project is 3 years. $20.25. Okay. 20.25. The year 1 will not be affected. 20.5 or 25. So let's get the cash flows. We have 220 minus 66 minus 66 plus 94.5. This is 248.5. Should be not the same. 220 minus 66 plus 20.25. 174.25. 174.25. 174.25. So we have the cash flows. Let's compute the NPV. So this is 20.25. 20.25. Is that okay? Now we want to get the NPV. Okay, let's just get the NPV here. Let's get the discount factor. Discount factor here. Discount factor. And we're using 16.85%. That is where now you apply this formula. Because 16.85 is not in the tables. Alternatively, you can round off to 17%, but the best thing is to do this. So get this. So for year 1, you will say At what point are we supposed to use 4 years or 3 years? We are not supposed to use 4 years at all. Or is there a point they have talked about 4 years? It's just a mistake that we had made. They are saying the useful life is 3 years. Fred, we are saying the question says the useful life is 3 years. I don't think they have mentioned 4 somewhere, 4 years anywhere, unless I'm not getting your question right. Fred, I want you to respond so that we can proceed. In the meantime, the others get these factors. Get these factors. No, it cannot be 0. Oh, yeah. This formula is misleading. We should have, oh, this is not an annuity. This is a lump sum. This is a lump sum. It's 1 plus r power negative n. 1 plus 0.1685 power negative 1. Then you get the rest. So yours, Douglas, could be correct. 0.8558. Douglas, have you done it this way? 8558. Then year 2. Year 2. 7324. So kindly make that change. The first formula was for annuities. 6268. 6268. So get these figures. Let me also calculate. So 248.5 times 0.8558. 212. This is 212.67. Then the other one, 174.25 times 0.7324. 127.62. Then the other one should 174.25 times 0.6268. 109.22. So the base NPV should be negative 450 plus 212.67 plus 127.62 plus 109.22. Are you getting negative? Negative 0.49 million. So that is the base NPV. Now we are not done. We are supposed now to get the adjustments. We are supposed to adjust this figure. We are supposed to adjust this figure with present value of interest tax shield and the present value of issuing costs. So let's go back to the question. We want to know the amount borrowed. Step number 3 now. Step number 3 say prepare a loan amortization schedule. Prepare a loan amortization schedule. Prepare a loan amortization schedule to ascertain the amount of interest payable. Prepare a loan amortization schedule to ascertain the amount of interest payable per year. The amount of interest payable per year. The amount of interest payable per year. Now, I want to wrap this. Kindly. The base NPV you have said is negative 0.49 million. So I want to wrap this so that we can compute we can prepare the loan amortization schedule. And I believe you've all done this. If you have not, kindly take a screenshot. So that we can move on. Okay, fine. So why are we preparing the loan amortization schedule? Because we want to know the amount of interest payable per annum. So here it's loan amortization schedule. Loan amortization. So the loan is payable amount borrowed. We start with the amount borrowed. Or loan amount. Loan amount. That is where the problem is. If we get the loan amount, we'll be good to go. So the loan amount is how much? How much was borrowed? Let's go back to the question. The question says, paragraph 2. The assets of the project will support debt finance of 40% of its initial costs, including issue costs. The loan is to be repaid in 3 equal installments. The balance of the finance will be provided by planning of new equity. Issue cost will be 5% for the equity and 2% for the loan. So we want to compute the amount borrowed, and we're so told that 40% of the 450 will come from debt, including the issuing cost. So here, debt, let's start with debt amount. Debt is 40% of 450. 40% of 450 is what we are going to borrow. This is how much? $180. Equity, 60% times 450. That will be $270. Around 270. These are millions. Issuing cost on debt. Issuing cost on debt. Issuing cost on debt. We are told 2%. 2% times 180. Issuing cost on equity, 5% times 180. No, 270. So 2% of 180 must be 3.6. Now, just a minute. There is a point that you're likely to get wrong. Let's go back to the question. The question says 40% including issuing costs. Including issuing costs. So this 40% must include the proportion for 180, must include 180 plus issuing costs. That means this is not going to work. This will not work. This will not work. Because with the issuing costs are, just a minute. Sorry for that. This 180 that you've seen here, this 180 is at 98%. 180 million is at 98% because 2% is the issuing cost. Debt, that is for debt. So here, let's say debt issuing cost. This question can debt issuing cost is, we are saying 180 million is 98%. How about 2%? How about 2%? Because these two should give us 40%. So this will be 180 million times 2 over 98 over 98. Then equity issuing costs will be 270 million is equivalent to 95% because the issuing costs are 5%. How about 5%? Because these two should give us 60%. So this is X. So 270 times 5 over 95. So get that. 3.6. Yeah, 3.6. 3.674. 734. Then the other one 14.21. I want to believe you've understood what you're saying. So what you're saying is that we have the initial costs for 50 million plus issuing costs. Plus issuing costs. Then those two, 40% should be debt, 60% should be equity. 60% should be equity. So that is what we should have. That is what you're supposed to do. So amount borrowed now, it is this 180 plus the issuing costs. So amount borrowed is equals to 180 million plus 3.6 734 million. So that should be 183. 183.6734 million. Now we want to compute the installment. It's 0. What? Which is okay, fine. So 183 is okay. Eh? So this 14.21 is okay. Okay, fine. Let's continue. So we're saying the total amount borrowed is 183. That is the loan amount. The loan amount. We want to get the installment. Installment, we say present value of annuity is equals to the annuity times present value interest factor R% power n. The present value of annuity is the loan amount. This is the loan amount. This is the installment. And this is the annuity factor from tables. So here we will say 183.6734. Remember, we want to get the installment is equals to installment times present value interest factor annuity debt. They are borrowing at what cost? At the risk-free rate. That should be 10%. That should be 10%. 10% power 3. Because they are paying in 3 equal installments. They are paying in 3 equal installments. So you divide both sides by present value interest factor, 10% power 3. Present value interest factor, 10% at period 3. So installment get the installment. Because we are supposed to divide, what is the factor? 10% for annuities at period 3. 10% for annuities at period 3 should be 10%. 2.4869. This one. 2.4869. 2.4869. No. We are saying period what? 1, 2, 3. Yeah, that's okay. That's okay. 2.4869. That is what we are dividing here by. So we divide 183.6734 divide by 2.4869. Are you getting 73? 73 point. The installment is 73.85. So how many days more? Let's have 4. 8564. 8564. That is the installment amount. 8578. I'm getting 8564. Another person? Now, loan amortization schedule. Loan amortization schedule. We have here 1, 2, 3. balance brought forward. It's the amount borrowed, 183.6734. Here we will charge interest at 10%. Then here we will have our installment. And here we will have balance carried forward. So let's charge interest. Let's charge interest at 10%. So 10% of 183.6734, it's 18.3673. So 73.8564, 73.8564, 73.8564. So let give them, okay, I don't know where. This is A, this is B, this is C. So this is A plus B minus C. So let's have that. 183.6734 plus 18.3673 minus 73.8564. That is 128.1843. 1843. That is what we bring forward here. 128.1843. Charge interest at 10%. This will be 12.8184. Then we charge interest 1843 plus 12.8184 minus 73.8564. We get 67 here. 67.1463. So here 67.1463. You charge interest at 10%. This will be 6.7146. Here we are supposed to get 0. Unless you are wrong somewhere. 67.1463. It's 73 minus 73.8564. Yeah, 0, So we are right. Now, this is all what we wanted. You can imagine. This is all what we wanted from that calculation. Because this is what will give us the tax shield. That is what will give us the tax shield. So let's compute the tax shield here. Present, hey, we also need the present value of interest tax shield. Hey, this question. So we get the tax shield, then we do what? So just allow me to rub this part. Allow me to rub this part kindly. Are you done with this part? You can take a screenshot if you're not. You can take a screenshot if you're not done with that part. Okay, fine. What do we want? We want to compute the present value of interest tax shield. We want to compute the present value of interest tax shield. Let's start with year 1, 2, and 3. Interest amount, it's these figures here. 18.3673, 12.8184, 6.7146, 7146. Then we have what here? Tax rate is 30%, tax shield, which is times 30%. Times 30%, we get the tax shield. Yes, and it's, yeah, the time is still 3 hours. No additional. But I would not advise you to start with such a question. This should be a last question. 0.5.510. Let's have the figures in 3 decimal. Oh, okay, let's be consistent. Let's have 4 decimal places. Let's be consistent. Let's have 4 decimal places. 12.84, 12.8184 times 0.3. This is 3.8455. Next, 6.7146 times 0.3, 2.0144. That is tax shield. Then present value interest factor. We want to get the present value now. Remember, we said present value of interest tax shield. Present value of interest tax shield. We are discounting at 10% here. This is 10%. So this is 0. At 10%, this is 0.9091. This is 0.8264. This is 0.7513. I don't know. Can check. 991, 8264, 7513. Yeah, that's okay. So present values now here. $5.5012 times 9091. This is 5.0093. Let's maintain our 4 decimal places. 8455 times 0.8264. 3.1779. 2.1, 2.0144 times 0.7513, 1.5134. So then total is 50093 plus 3.1779 plus 1.5134, 1.5134. So this is 9.7006. That is the present value of interest tax shield. You can imagine all those calculations that we've done. That is what we wanted. So let's now adjust. Let's now do the adjusted NPV. Let's adjust the NPV. Adjusted NPV. Adjusted NPV, we start with the base NPV. It's negative negative, so let's have it in brackets, 0.49. 0.49, add present value of interest tax shield, present value of interest tax shield, so 9.7006, you less present value of the issuing costs, the issuing cost of equity, issuing cost of equity. What do we call them? Present value of issue cost on equity. Present value of issue costs on equity. This figure here, 14.21. We say this one is in present value terms. This one is in present value terms, so we do not need to make adjustments. So you just say 14.21. You are lessing. Then you less present value of issue costs on debt, which is what? 3.6734. Then you get the adjusted NPV. You get the adjusted NPV. So we have 0.49 plus 9.7006. This one is negative, minus 14.21 minus 3.6734. So I'm getting negative 8.6728. 8.6728. Yeah. So this is what we call what now? Kusumbua watu. Because this is a lot of work. This is a lot of work. However, this part here, this was the challenging part. This one. This was the only challenging part, and I would not wish it's that question must have been 20 marks. That question must have been 20 marks if these guys were fair. But from where I have, there are no marks. Not less than 10. It cannot be less than 10. So this part, I would not wish the same to be repeated. They should just be straightforward. They say 40% is debt, equity 60%. The issuing costs are maybe 2% of this 180 and 5% of this 270. Just a straightforward thing. Then you continue. I just hope you followed. Or Mulinga is 10%. It's 10 marks. Are you sure? So I just wish you followed. You're followed. So we started by getting the cost of equity. And again, let me tell you, never leave these questions unattempted. You must attempt. You must attempt. Even if you're not going to complete the question, but attempt. Just write what you can remember. Just write what you can get that particular time. For example, we said the cost of equity. That cost of equity you can calculate quickly because it's not complicated. You get the cost of equity. You can also make sure you also get the net cash flows. The net cash flows were straight. It is just the normal thing. You get the net cash flows. Just do what you can be able to do. What does not depend on something else. For example, the cost of equity does not depend on any other thing. It was independent. Getting the net cash flows was independent. You should get the net cash flows. After the net cash flows, we computed the base NPV. Maybe The base NPV, you may get it wrong because maybe your cost of equity or maybe the cash flows one, but still calculate that. Then if you feel you're going to waste a lot of time getting the present value of interest tax shield, just come here. You skip, just come here. You write adjusted without calculating the present value of the interest tax shield, because that will take a lot of your time. Just come here, say adjusted NPV. You say base NPV, this figure that you got, then you less add present value of interest tax shield. You just say add present value of interest tax shield. You have no figure, so it will be blank. Less present value of issue cost. These issue costs, these are direct. You'll compute them. They do not need any discounting or what we said. They are in present value terms. So you write them here and you leave it at that point. So in that case, you will have eliminated this bit that is likely to take a lot of your time. Are we together? However, if you are in a position to do all this, you can do, but that is how you gather marks in an exam, doing what you are able to do. So let's proceed. Any question before we proceed? Any question before we proceed? There is a question in the past paper on adjusted present value. If I get the year, if I recall the year, I will share with you to go and attempt. I'll share with you to go and attempt. Let's go back to the WhatsApp group. Let's go back to the WhatsApp group. Let's go back to the WhatsApp group. There is a handout I shared on the WhatsApp group sometimes back. Let me get that handout. Advanced financing decisions part 2. Let me reshare this. Let me reshare. I've reshared. Yeah, definitely. What we'll be doing during the revision time is how to survive. How to survive. Because sometimes people do not fail because they don't know. People fail because they do not get, or rather they do not have the best approach to the exam questions. Yeah, so we will go through that. So I've reshared the handout that I want us to look at in the WhatsApp group. Kindly check. We must finish this today. Okay, we can have a 5 minutes break. Let's have a 5 minutes break. 5 minutes break. Let's proceed. Now, are you back? Are you back? I want us to proceed. Diana, are you back? Okay, fine. Now, we have what we call that handout there. That name is a bit difficult. We have what? Macaulay duration and modified duration. Okay. I wish you guys could assist me to read that name.
The partner's capital account do have the same format with the partner's current account. This account has the same format with the partner's current account. So we have the details column and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column. We have John. We have Kelvin. We have Renette. This, remember, is the credit side. And also the figures are in what? In thousands of shillings, like that. In thousands of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, the liabilities taken over, and the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners, or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing of the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to cross all those accounts. You cross off all those particular accounts without skipping any. So the first item is the net profit. Now, this net profit, we know that this one has been shared among partners. And therefore, these particular items here, that is the any interest on drawings, any salary or commission, any interest on capital, and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information note number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which you have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was taken over by partners. Remember, you have said any asset taken over by partners should be debited in this account, should be debited in the partner's capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partner Kelvin. That is the last item in the trial balance, was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liabilities of the partnership were taken over by the company. So we are given the assets and liabilities which were taken over by the company. Property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities, all those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance, not the value which you're given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23,800. And I hope you can see I'm not even considering the values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when closing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa? Yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So their value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank what? The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. So below motor vehicle, we have equipment. Still, as per note number 4, equipment were taken over by the new company. The carrying amount for this is 25,240. So, and then from there, we have equity investment. Equity investment, this one was taken over by the partners. So being an asset taken over by partners, are we supposed to debit that here? No. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the equity investment, note number 2, equity investment were taken over by partners at their fair value of 18 million and allocated among partners using their profit and loss sharing ratio. Now, if you go back to the trial balance, you can see we are given the equity investment, and basically we are given the equity investment in the trial balance at the fair value. The fair value given in the trial balance is 10,000, but you're told in note number 2, this equity investment were taken over by the partners at their current fair value of 18 million, and this one was shared among partners, was distributed among partners using their profit and loss sharing ratio. So basically what that means is that this particular investment were taken, when it was being taken over by the partners, it had a value of this. So therefore we are going to share, or the partners will share this asset at this value, not at 10, but at 18. And therefore, how do we account for this? Which double entry are we going to make in relation to this equity investment? Remember, this equity investment, this one is recorded in this account at this particular amount. So, and basically remember this is an asset. This is what? An asset. So therefore, these are debit balance on this account. So what we need to do is we cross off that account because those investments were taken over by partners. So we need first of all to cross off this account. So automatically we will cross off that account with 10,000. So therefore here you can see we are crediting this account which is called equity investment with 10,000. Then we will debit this account. We will debit the partner's capital account, but this account will be debited at 18 million. At 18 what? Million. So how do we account for the difference? The difference which is 8,000. You can see this account has been debited with 18. So this account credited with 10. So we have now to credit another account with the difference. And actually this difference we can refer to it as a revaluation gain, because when these equity investments were taken over, they were revalued from 10 million to 18. So this is a revaluation gain. Now this revaluation gain, where do we take it? So this revaluation gain will be taken to the realization account. Will be taken to the realization what account? Because by the end of the day, we have to complete a double entry. We debit this account with 18 million. We credit equity investment with 10, and still we credit the realization account with 8. So therefore, that 8 will be credited here. It is a revaluation gain on equity what? Equity investment, which is 8. Then we need to debit this account with the 18 million. But remember, those investments were taken over by the 3 partners. That's why we are told in note 2, they will be distributed to partners using their profit and loss sharing ratio. The profit and loss sharing ratio we know is this: 5 all over 10, 3 all over 10, and 2 all over 10. So we are going to take the value of the investment. The investment was taken over at a value of 18 million or 18,000 for that case. So we share out that using this. So the first partner will get 5 all over 10, which is basically half, and that is 9,000. The other partner will get a share of 3 all over 10, which is basically 54. And the other partner will get a share of 2 all over 10, which is basically what? Which is 36. Which is what? 36. If you add all that, it should give us an amount of 18. That's basically how we account for that equity investment, which was taken over by partners. Let's go back to the trial balance. And I hope you can see there is nothing we have skipped there. We have accounted for all those items. What we skipped is the first item. That is the profit. Then below equity investment, what do we have? We have the partner's capital account. Now the partner's capital account, that would be the opening balance in this account. And I hope you can see those balances in the partner's capital account in the trial balance. They are on the credit side. So what do? We record those balances here and we record them as credit balances. So the capital account balance for Kevin has a balance for John, that is 43,700, Kevin 28,500, and Renette 18 what? 18,800, 18,800, 18,800, 18,800, 18,800, 18,800. Sasa 18,800. Yes, so then from there, below that, we have current account balances. Current account balances, those are balances to be recorded in this account. So, and equally, I hope you can see the current account balances, they are credit balances. In the trial balance, they appear on the credit side. For John is 14,790. For Kevin is the 12,960. 960, and basically for Renette is what? 98.50. 98 what? 98.50. 98 what? 50. 98.50. So then below that we have drawings. We have drawings. Where do we record drawings? Drawings, those ones are supposed to be credited, to be debited in this account. Remember, I've said from whatever you did in financial accounting, you should be able to recall what we record in this account. On this side, we record drawings. In case we had any interest on drawings, that one should also be debited here, but I hope you can remember you don't have any interest on drawings. In case we have share of loss, that one equally should be debited here. And then in this account on the credit side, we record what? We record any salary or commission to partners. Do we have any salary or commission to partners? None. Then we should also credit this account with interest on capital. And I think we have that. And then also what? The share of a profit. The share of what? The share of profit like that. Sasa? Yes, Doris, what you have said is that the investment which were shared by partners, they are shared at a value of 18 million. At a value of 18 million. That's what you are told in note number 4. We have shared out this investment at a value of 18 million. That's what you have said. That's why you have said we debit the partner's capital account at 18 million. So if you add all that, should give us 18 million. Yes. Now, what I want us to do before we move, we go back to the trial balance, I want us to record these items because we have recorded drawings. We have recorded drawings. Before you finalize, okay, I think let's first of all finalize with what we have in the trial balance. Below the drawings, what do we have below that? The loan from Kelvin. And there is some information which are given in relation to that. Note number 3. Additional information number 3, we are told the loan from Kelvin was transferred to the new company at its carrying amount. So loan from Kelvin is a liability. So that loan was transferred to the new company. So that is basically a liability. That is a liability which was taken over by the new company. So the loan from Kelvin. So, and I hope you can remember liabilities taken over by the new company, they should be credited in this account. So how much is the loan from Kelvin? The last item in the trial balance. The last item in the trial balance is 91. So that is a liability which was taken over by the new what? By the new company. So I think you can see we are done with crossing all those balances, all those particular accounts which are balances at the end of the year. Now what is remaining is for us now to post these items here. So these appropriation, we have said in case we had interest on drawings, that one should be debited here. Salaries and commission to partners should be credited here. Then we have interest on capital should be credited here. So let's credit interest on capital here. So for John is 43.70. For Kelvin is 28.50. And basically for Lynette is 18.80. Then we also have the share of profit, this one. So John is 16.850. Kelvin is 10.110. And Lynette is 67.40. 67.40. So we are basically done with posting those items there. Now what is remaining is basically for us to balance this account. Okay, before we do that, there is something we are almost forgetting. Can we record the purchase consideration which is given in the last note? The last note, note number 5. Sorry, not note number 5, note number 1. In note number 1, you are told the purchase consideration on a business purchase was agreed at 150 million. Where do we record the purchase consideration which was agreed? The purchase consideration record in the business purchase account should be credited. The purchase consideration which was agreed. And that is 150 what? Million. 150 million. I think basically we are done. So what is the remaining is for us to balance this particular what? Account. Now the first account which we have to balance is this one, the partner's current account. Partner's current account. Now this basically account shows the amount of money which the partners were entitled to receive from the partnership business. So the balancing figure from this account should be crossed off, should be transferred to this account. So that by the end of the day, we know the amount of money which each partner was entitled to receive. So the first account which we balance is this account here. Is this account here. So let's start by balancing this account here. And I've said the balancing figure will be crossed off to each account, will be crossed off to the partner's capital account. So how do we balance this account? We balance the current account for individual partners. So we will start with John. So we compare what we have on the debit and basically what we have on the credit. So I think on the debit side, we don't have any amount. What about on the credit side? In the current account of John, we have 14,790 plus 4370 plus 16,850. That's what you have on the credit side. So we take what you have on the credit side minus what you have on the debit side. On the debit side, we have 0. So we should take 36,010 minus 0. So the balancing figure will be on this side. Do we record it here as a balance carried down? No. So that balance I've said we transfer it to this account. So that balancing figure, we transfer it to the capital account, which is 36 what? 010. 36,010. Oh, yes. Thank you, Otito. Morimo is almost forgetting to record drawings. Thank you. Yes, we have drawings. We didn't record the drawings. Sorry for that. So the drawings, we have 4370, 4020, and what? And 29 what? 10. Thank you for that. Yes. So it basically means that we need, before we get this, we need to raise the drawings here. We need to raise 4370. 4370. And the amount which we get here will be 31, 6 what? 40. Now we cross off this particular amount. We cross off this particular amount to which account? To this account. And basically we follow the rule of double entry. You can see this account is credited. Sorry, is debited, sorry. Then to complete the double entry, we need to credit this account. We credit this account. So we will say that there is an amount coming from the partner's current what? Current account. The amount from the current account of John is this one, 31 what? 640. So we do the same for the other partners. So Kelvin, we add what you have on the credit. Whatever you have on the credit side is what is more. 12,960 plus 2850 plus 10,110. That is what we have on the credit minus these ones. Minus this value here, 4020. And that will give us 21,900. We debited here, we credited here to complete the double entry. So we do the same for Inet. So for Inet, we have 9850 plus 1880 plus 6740 minus what you have on the debit, 2910. And basically I'm getting 15,560. 15,560. Are you getting those values? Is that what you're getting? Yes. So basically in our case, we are done with this account. This is now what was required there. That is what was required in the partner's what? In the partner's current account. Now, then next, what we need to do is basically we balance this account. Now, what you have said is that this account will be having a balancing figure, and the balancing figure in this account can either be on this side. If it is on that side, it is a gain on realization, and that has to be shared among partners using their profit and loss sharing ratio. If the balancing figure is on this side, is a loss on realization. Equally, it will be shared among partners and taken to the partner's capital account. If the balancing figure is on this side, it is a gain on realization. Yes, can we balance this account to see whether we have a gain or what? We have a gain or basically what? A loss. So let's add what you have on the credit, that is 2,700 plus 68 plus 8,000 plus 9,100 plus 150,000. So basically I'm getting 206,600. That is what I'm getting on the credit. What about on the debit? And you confirm whether you're getting the sum, that value on the credit. On the debit, we have 28,400 plus 23,800 plus 72,950 plus 37,730 plus 10,580 plus 25,240. So on the debit side, I'm getting 198,700 on the debit, and that is what I have on the credit. Are you getting those values? Are you getting those values? Yes, so that is confirmed. So meaning that the side which is more is this side, the credit side. So meaning, taking into account this side is more, the balancing figure will be on the debit side. On the debit what? Side. And actually the balancing figure should be the difference between those two values. 198,700 minus 206,600. So the balancing figure will be 79. 79, that is a gain on realization. So that gain on realization, we said it will be shared among partners using their profit and loss sharing ratio. That will be shared between John, Kelvin, and Renette. And who? And Renette. We are going to share out that using their profit and loss sharing ratio, which is this one. So the share of John will be 5/10, which will be 39.50. What about the other partner? The other partner, that is Renette, Kelvin, will get a share of 3/10, which is 23.70. And the other partner will get 790 times 2. And basically that is 15 what? 15.80. Is that what you're getting? A gain on realization. Gain on realization, 39.50, 23.70, and 15.80. 15.80. Confirm whether that is what you're getting. Is that what you're getting? 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 Steven, Zido, is that what you're getting? Otito? Sam, is that what you're getting? Doris, Anna, are you getting that value? Are you getting that? Yes. So basically, after doing that, finally, what we need to do is we balance this account. We balance this account, we balance the partner's capital account, and basically the balancing figure in this account, which always is on this side, which always is on the debit side, it represents the amount of money to be paid to each partner. So the balancing figure on this side represents the amount of money to be paid to each partner. Remember, we say that the partners here have accepted to sell their business to the company. They must be paid something called purchase consideration. So what we balance this account. The balancing figure which we get here is the amount to be paid to each partner. And once we add the total amount to be paid to our three partners, the amount to be paid to John, Kelvin, and Renette, that one always has to be equal to this. Has to be equal to the purchase what? Consideration. Can we do that? So automatically we take what we have on the credit minus what we have on the debit. We start with John. We take 43,700 plus 31,640 plus 39,50 minus what we have here, 9,000. That will give us 70,290. So that is the purchase consideration which John will receive. Out of this 150, John will be paid 70,290. What about Kelvin? We add what we have on the credit, 28,500 plus 21,900 plus 23,70 minus what we have here, 54. That will give us 47,370. So out of this 150, that is basically the amount Kevin will get. What about the net? 18,800 plus 15,560 plus 1850. That is 1580 minus 36. And basically I'm getting 32,340. 32,340. Is that what you're getting? the amount to be paid to each of the partner, the amount to be paid to each of the partner. And basically, we are saying if we add this, and that should give us the amount of 150. So can we confirm? Because that is basically how we should confirm. So we take 70 to 90 plus 47, 370 plus 32, 340. Yes, you can see that basically give us that. That give us what? That basically that's how you confirm you are correct. And equally that basically what was required in that particular what? In that particular account. So what we have done basically, we have crossed off the books of account of who? Of the partnership. Of what? The partnership. Sasa? Yes. So that's basically how we cross off the books of account of the partnership. Now, there are still other questions. Like I think there was a question in 2021, which is basically similar to this one, whereby the examiner will just require you to prepare the realization account and the partner's capital account. You will not be required to prepare this account. Are we together? If you happen to come across such a question, you are not required to prepare this account. Now, all these items you are recording here, you record them in this account. Are we together? If you're not required to prepare this account, you're just required to prepare realization. And this account, all these items, you record them here. So for example, these balances, in the opening balances here, you'll come here after recording this one, you'll come and record this opening. But you'll not refer to it as a balance carried down because you already have a balance carried down here. You'll say that this is the balance from the current what? From the partner's current account. You record these balances here, all of them, and then all these items, you credit them here. All these items, you do what? You debit them here. So in case the examiner has not required you to prepare this, all these items, you record them here. I think there is a video I'll be able to share with you of a question, I think in 2019 or 2021, which is basically similar to this, but the examiner was not requiring candidates to prepare this account. This one, the candidates were required to prepare this and this. So all these items, you record them here. Sasa? Yes. Now, having that, I want us to finish by preparing the statement of financial position of the new company. That's what you required in Roman 4. But before we prepare that that account. Is that the case? Yes. So let's basically finalize by preparing the statement of financial position. Preparing the statement of financial position, but there is an account we need to prepare. Remember what we have said. When opening the books of account of the partnership of the new company, we have to prepare an account called the business purchase account to determine whether we have goodwill or basically capital reserve. But let's first of all, we prepare the statement of financial position. We will be able to, I will show you how to prepare that. So we prepare what is required in Roman 4, opening statement of financial position of the new company, JKL Limited. As at which date? We're given that date. We are given that date. We are given that date. My Modimo's question is disappearing here. The date is as at first of what? As at first of my question is disappearing. Yes, it's at 1st of July 2024. This is basically immediately after the new company took over the business of who? Took over the business of the partnership. Took over the business of who? Of the partnership. Yes. So here, what you're going to record, we are going to record the assets that are the assets and the liabilities which were taken over by the company from the partnership. And when recording the assets here, we record them at the fair value. The assets were taken over at the fair values given in note number 4. So what we do, we record those assets here at their fair value. So we have the non-current assets. So let's record the asset from note number 4. Actually, here we have so many free marks because you just need to pick those assets we have in note number 4. So the first asset which was taken over is basically property, and we record that asset here at the fair value, not the carrying amount we have in the trial balance, the fair value. So this one is 74,560. So then below that we have plant and machinery. Plant and machinery was taken over at 35,200. 35,200. Then we have motor vehicle. Motor vehicles which were taken over at a value of 95,20. Then we have office equipment. Office equipment, you can see all these are free marks, which was taken over at 23. 6 what? 23,660. 23,660. Then inventory, account receivables, those are items of current asset. But what we need to do here, we are going to leave some space because there is an account we need to prepare that is called the business purchase account. We determine whether we have a goodwill or the asset and abilities of partnership was taken over by the new company as a goodwill or capital reserve. So leave some space here. In case we have a goodwill, we are going to record it there. And then from there, we proceed and basically record the current what? The current assets. Now, the current asset, we start by recording inventory, which is given in note number 4. We are told the inventory was taken over at the book value less 15%. In other terms, we can say the inventory was taken over at a value equal to 85% of the book value. Can we say so? Can we say that the inventory was taken over at a value equal to 85% of the book value? Yes. What is the book value? The book value is what we have in the trial balance. And basically those inventory are the second item in the trial balance. The book value is 28,400. 28,400. But in this case, there is also some information which we have in note number 5. Let's go to note number 5. We are told the new company issued 2 million ordinary shares of sharing 10 each at par value. So this new company issued shares, 2 million shares, shillings 10 each. And then you're told the proceeds. The proceeds is the amount which was received from the issue of shares was utilized to settle the bank overdraft and the loan which was taken over, with the balance being used as working capital. There are some instances whereby you may be told that maybe part of that money which was raised was used in terms of buying additional inventory. So in case maybe there was additional inventory which was bought, we should add that here, but none. So let's get 85% of 28,400, and basically that will be 140. So then we go back to note number 4. Below inventory, the other asset which was taken over is the account receivable. Account receivable, which was taken over at book value less 10%. In other terms, we can say that this one was taken at a fair value of 90% of the book value. 90% of the book value. The book value is, we have it in the trial balance, the third item in the trial balance up there, which is 23,800. 23,800. So we get 90% of that.